Pointing the finger and buying the dip. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Stocks took a breather yesterday while bonds kept rallying. You look at what's happening today, stocks resuming their rally while bonds take a breather. You can see the S&P 500 up 0.5%, 47.24. The Russell 2000 outperforming, gaining at least double what the S&P 500 is on a percentage basis. And of course, we see a little bit of a reversal in bonds. The 10-year yield moving up about 4.6 basis points, 3.89%. Earlier, it dipped below 3.83%. And of course, if the narrative of the Fed looking to cut rates next year holds, that would mean a weaker U.S. dollar, which is why you're seeing the dollar index come down 0.5%, Romaine.
Yeah, absolutely. Here, of course, the price action coming off yesterday had a lot of people scratching their heads, trying to make sense of yesterday's sell-off, with the finger being pointed at that groundswell of short-dated bearish options activity that flipped the stock-bond correlations and really rattled all sense of sanity and stability, at least for a few hours. The zero-day options boogeyman has been closely watched since last year when SIBO expanded the product to cover all 5 weekdays. Strategists over at Goldman, J.P. Morgan, they're saying that in the past, well, rising client demand for those contracts typically forces market makers to abruptly hedge those exposures, and that leads to those outsized price moves in very short periods of times, like what we saw last afternoon. Now, for what it's worth, SIBO published a study in September that pushed back on that narrative, saying they found no evidence here that zero-day options were risking any sort of destabilization in the broader market. But even before that technical blip, Wall Street strategists had warned that multi-week rally in equities was starting to show some signs of fatigue. The quant strategists over at Citi say they're more cautious already on any further price momentum, citing that persistently wide gap between implied and actual 10-year yields and credit spreads. However, a separate team at Citi, this is the fundamental strategist team led by Scott Croner, they say that while the market does look ripe for some day-to-day pullbacks, they advise folks buy those dips. That appears to be exactly what's happening today, though not the two-fisted full dip buying that would be necessary to claw back yesterday's massive losses. Nevertheless, Croner and his team at Citi are expecting the S&P 500 to weather the short-term storms and end the year, next year, I should say, at 5,100. That's up more than 8% from yesterday's close, Scarlett, and that matches year-end targets that we've already heard from some other names out there, including BMO, as well as the folks over at Goldman Sachs. And while 5,100 isn't the highest on the street, it is well above the median.
Yeah, maybe it's 1.5-fisted dip buying, right? Okay. Underpinning all of that is the idea that the economy will keep growing. The latest data showed a slight downward revision to GDP last quarter, solid growth, but not at a 5% annual rate. So for this quarter, lower estimates of consumer spending and inflation were always going to be a drag on the economy. Where does that leave us now? According to the Atlanta Fed's GDP Now index, the U.S. economy growing at about 2.7% clip, the highest level for this quarter. Now, signs of the cooling economy reinforce this narrative that the Fed is on track to start cutting rates in the first half of the year. And small companies, that is the white line, are seen as immediate beneficiaries of lower borrowing costs. They entered a bull market this week. That is, they're up 20% since late October. The Russell 2000 has outperformed the big caps by a wide margin. You're looking at the yellow line, which is the S&P 500, the market cap weighted index, and the blue line, the S&P 500 equal weighted index, have each gained about 14 to 16%, nowhere near that 22% for the Russell 2000. Romaine?
All right, let's kick things off to the close here with Kuei Wen, research affiliate, CIO of Equity Strategies. Kuei, great to have you here on set.
Nice to be here.
Let's talk a little bit, though, about the rally. I mean, we can kind of take yesterday out of the equation. Who knows exactly what led to that sort of blip here. But there did seem to be a big sentiment shift, both on a fundamental level and to a certain extent on a technical level in the weeks leading up to that. And there's a big question right now as to what drove that and whether that continues into next year.
I think it absolutely continues into next year. The initial shift was really just people looking at the fundamentals and realizing that the fundamentals were solid. Valuations were not particularly stretched. Earnings were coming in, reasonably well. And adding fuel to the fire was the Fed's pivot on interest rates. And so if you really have a situation where the economy is going to be okay, we're inching closer to a soft landing, and the Fed's going to be able to cut rates, that just leaves a lot of upside for all sorts of risk assets.
Will that upside be driven by, I guess, more of the bottom-up fundamentals? There was a great Bloomberg opinion piece today by Mohammed El-Arian kind of lamenting the idea that we're still sort of tethered to the Fed and every word that comes out of Jay Powell's mouth in terms of pricing in the markets.
I certainly think that it will be tied more to fundamentals. I mean, one of the things that the Fed looks like they're going to be able to achieve is a soft landing. Those are few and far between, and anytime you achieve a soft landing, it sets the market up for a really, really great rally. You just take a look at what happened in 1994 and 1995. With that soft landing, 1995 was a fantastic year for equity markets.
And we should point out, Powell has cited that specifically as sort of what he was trying to emulate here.
That's right.
So what about the fundamentals for the small caps? Because we're just showing a chart on how they've outperformed. They've entered a bull market this week, up 20% from their October lows. Do the fundamentals support that?
Oh, absolutely. If you look at small cap stocks, they're extremely cheap relative to large cap stocks. They typically trade at around a 20% valuation discount. And when I say 20%, I'm looking at a variety of valuation metrics, including book to price, dividends and buybacks, et cetera, cash flow. Currently, by our analysis, they're trading at around a 50% discount. Compared to a historical norm of 20%. And so in order to get back to a historically normal level, they would need to outperform large caps by around 60% cumulatively. So if you think that they can do that over 5 years, that's close to a 10% outperformance annualized during that time.
Does it have to be either or, small caps at the expense of
big
caps?
Absolutely not. Absolutely not. I mean, I think that if you look at large caps, everybody talks about the Magnificent Seven and how expensive they are. But even within the Magnificent Seven, you have two stocks, Meta and Google, that are priced at around 25 times earnings. Very reasonably priced for companies of that quality. And so it could just be that you have a big roaring market in small caps, and large caps are just sort of ho-hum okay.
And as I'm sure you know, there's been a lot of discussion that when you look at those big cap stocks, particularly the healthier ones like a Microsoft, like an Alphabet, and even to a certain extent a Meta, that there is sort of value baked into some of those names, maybe not in the traditional sense here, but I know there's been a lot of discussion about whether we're sort of looking at value in the modern era all wrong.
Oh, absolutely. I totally agree. I mean, if you look at Research Affiliates' active value strategies, which we sub-advise for PIMCO, we actually own both Meta and Apple, and we've owned Apple for quite a long time. Now, given the rally, we've trimmed back on that position over time. But the way we look at it is that these are companies that are extremely profitable with strong cash flow, strong capital discipline. You look at the buyback set, for example, the return of cash to shareholder. I think that they can justify higher valuations, and given where they are, certainly they represent some value.
And of course, that was one of the big arguments that Buffett's team made when they entered those initial positions in Apple a few years ago.
Yeah, absolutely. Yeah. Well, Buffett, of course, known for picking winners, especially companies that he wants to invest in, but also looking for companies that may be making acquisitions or being takeover targets. There's been a pickup in M&A activity. How do you see that growing in the new year, especially as borrowing costs come down and companies can take advantage of their equity as currency?
Certainly some of these companies that are very, very large can do that. Now, I do think that that will tend to help some consolidators. So, for example, semiconductors. You can see a lot of consolidators there. You can also see mid-cap and smaller cap technology hardware. These are both areas where we think that there continues to be pretty solid growth and very reasonable valuations.
Kuei, always great to talk to you. Have a wonderful rest of the year, and we'll catch up with you in 2024. Kuei Wen of Research Affiliates, CIO over there for Equity Strategy, as we kick you off to the close here on this Thursday afternoon. A conversation coming up about the Great Recession debate, why Citi, Deutsche Bank, Wells Fargo are among those predicting a recession next year, when most forecasters are not.
They're the outliers. Plus, why the White House is considering a tariff increase on Chinese electric vehicles and what that would mean for the U.S. EV market.
And earnings season, it never stops. Nike earnings scheduled to hit after the bell tonight. A preview coming up with Adrian Yee over at Barclays. All that and more coming up in a bit. This is The Close on Bloomberg. Bloomberg is out with its latest survey of economists on conditions in the U.S. economy here, and they're finding that most are not forecasting a recession over the next 12 months. But there are still a few folks out there doubling down on the expectation for pain for American households and businesses in the new year, and they include some big names: Citi, Deutsche Bank, Wells Fargo, among those. Steve Matthews joining us right now, down from our Atlanta bureau, to talk a little bit more about this here. And Steve, we'd be remiss in not starting this conversation without a look back to basically 12 months ago. This was the headline on the Bloomberg terminal, December 20th, 2022. Economists put U.S. recession odds at 70% for 2023. Okay, we all know how that all sort of shook out here. Why am I to believe that these predictions for 2024 are going to be any more accurate?
You have good reason to be skeptical. I mean, a year ago, there was a 70% odds put by economists for a recession. Most of the big firms were predicting a recession during the year, and really many of them at the early part of the year. And, you know, one by one, they have been dropping off. The Federal Reserve was predicting a recession. In July, they said, nah, you know, Jay Powell said, it looks like it's going to be a soft landing. That's what our staff says. Bank of America switched its call. You know, one by one, there have been, Barclays just very recently switched its call. So there's reason to be skeptical that 6 months late, you know, into the new year, that some of these firms will be switching their calls as well.
This gets to this idea, though, for those folks who are sort of standing by the recession, the case for a recession here. What are they sort of pegging that to? And are we talking about sort of like that real sort of deep recession where we're all hurting? Or is this one of those sort of technical recessions where we get the 2 quarters of contraction and then, you know, it's kind of a forgotten a quarter or two later?
Yeah, it was interesting. Deutsche Bank's economist was telling me, yeah, we're predicting a recession, but, you know, it's really just a technical recession. It's not going to be that bad. And that was kind of the general view of those who are predicting a recession, that it's not going to be that bad. It will be short, maybe a quarter or two. And, you know, in 2020, you had unemployment go up to 15%. Nobody's predicting a big increase in unemployment. Could go up a little bit in the view of the recession people. And the basic cause of it is two things. You're already seeing some weakness in the job market. Those who believe in a recession think that that's going to continue and to get worse, and that's going to lead to consumer spending weakening. That the whole idea of people had savings built up during COVID, those savings are being evaporated, so therefore you're going to see a cutback in spending. Plus, you've had interest rates at 40-year highs, and that eventually is going to cause, you know, some pain.
Well, that's been the bear call for a while now, and it so far hasn't exactly panned out. I mean, when it comes to these GDP forecasts, Steve, from economists, this is really more of a thought exercise. It's not like the banks themselves make positions or take positions according to these forecasts at all, right? So
yeah, that's exactly right.
So I mean, it's great for them to publish it and for us to discuss it and debate it, but at the end of the day, you only know after the fact. And after the fact, it's not even these private firm economists who make the call on a recession. It's a group of elite economists at the National Bureau of Economic Research that do that.
Exactly right. And I mean, I've talked to the NBER folks, and, you know, they don't predict anything. They wait until 6 months, 18 months after the fact. So, you know, if there is a serious downturn, it's going to be a long time before we actually have it officially declared.
Is there a sense here, though, when we look at the flip side of this, Steve, for those folks who are sort of painting a much rosier picture of economic conditions going forward, is there some sense here that maybe they're a bit too optimistic?
Well, I think that the optimists are relying on the fact that, you know, there was a sense that unemployment was going to have to go up really high to bring inflation down. Well, that's not happening. Inflation has come down pretty sharply, and we're going to get more figures tomorrow. It's come down without there being any pain in the economy. Unemployment's still under 4%. So if you believe that the expansion can continue and that inflation can come down without there being pain, then there's reason to believe the expansion could continue.
Steve, the Fed's own staff in March started to reduce the odds of a recession. Are they ahead of the curve, behind the curve? Do they have access to more information that private firm economists don't?
Yeah, you know, by and large, it's funny because you often hear on Wall Street, well, the Fed must know something when they're doing something that's a surprise. Well, the Fed has staff and they must know something. They do have a little bit more information about what's happening in the banking system. So to the extent that there's problems with banks or that the banks are doing really well, they have a lot more information than you or I do. But just on economic data, the data they get and the private sector data that they have access to is really not better than what, you know, Goldman Sachs has or any of us.
Really interesting. Thank you for delineating that. Steve Matthews, Bloomberg U.S. economy reporter, giving us the story here as fewer and fewer economists are calling for recession, the few that are clinging on right now. And Romaine, it gets to that point where, you know, pay attention to what the Fed economists say when it comes to the banks, but maybe not so much the other things because we're all working with the same data.
Yeah, we're all working with the same data, but as you know, it's always that interpretation of the data. The data isn't infallible. But, you know, look, I guess they are, as you said, they kind of have to make these predictions here. And we always quibble over that. We always should point out, I remember all the criticisms that like Mike Wilson and some other more bearish folks got this year. People focus on that headline, right? The headline prediction that the economy is going to do this or the market will do that. But they don't always read the explanation of how they got there.
That's fair.
And just not to just pick on Mike Wilson, but while a lot of his headlines turned out to be wrong, sort of the fundamental analysis that was baked into that actually proved to be right.
The process.
Yes.
The process was there. Perhaps the outcome didn't quite turn out.
Maybe people should do that, but of course people don't read these days. So.
Well, you know, we're all about the headline and the 140-word tweet, right? Or character tweet.
100 tweet? Is
I
that
know.
what they call them these days?
X. I don't know. How do you call it now? An X post?
X.
Response?
And whatever happened to Exhibit?
When was the last time you went on X or Twitter? I don't think anytime soon.
All right, it's coming
recently. All right, coming up, JP Morgan, Citi, they're among the banks moving to copy the private credit playbook. They risk losing billions of dollars in fees if they don't. We're going to have the latest on what they're doing next. This is The Close on Bloomberg. Now to our big take. Our focus is on the growth of private credit. The big publicly traded banks now want a cut of that action after losing out on billions of dollars in fees to private equity and private credit firms. Bloomberg's Paula Seligson has been covering the story, and she joins us now. And Paula, you write about how in one recent private credit deal, you look at the very end of the list of the lenders that were involved, and at the very bottom, towards the end, there was a small upstart player that was included, and that was JP Morgan Chase. Up until that point, the big banks like JP Morgan, like Citi, like Goldman were not really involved in private credit. What is their value add to the role now?
Yeah, so it's really interesting because what I think we're seeing is an evolution of the leveraged finance markets. So traditionally, banks have not lent high-yield bonds and leveraged loans. They've arranged them and gotten fees for doing so. You've seen direct lenders come in, take some of that market share, and now banks are trying to reinsert themselves back into that process. And the way they're doing this is they're looking for outside capital partners to work with. It's hard for a bank to do its own direct lending and provide large loans to highly indebted companies at scale because regulators essentially discourage that. So now they're trying to find outside partners where they still, the bank still arranges the loan, but the outside partners provides most of the cash.
So they're playing a matchmaker role and taking a commission, an introduction fee essentially for introducing the two parties. Are they putting their balance sheet at risk in any way? Are they taking on their own positions?
So it depends on the situation. So all the banks are still evolving their strategies and figuring out the best way to do this. What seems to be a common tactic is they put in a little bit of balance sheet, just a small portion. I think that aligns the incentive because they have some stake in the loan. And then the outside capital provider gives most of the cash and most of the debt to the company. But I will say this varies, and we'll kind of see how this evolves over time because just because a bank does a partnership doesn't mean it lasts either, right? So it's hard to always agree on how to underwrite and decide on credit risk. So it'll be interesting to see if these partnerships work and expand or if some of them might fall apart as the years go on.
That's what I'm curious about, too, because, we already know, at least in the past, when you look at the past vintages of some of the private capital deals here, the terms were certainly probably better than what they would have gotten had they gone through a traditional bank. Now, I know a lot has changed over the past year and a half, so those types of covenants may be a little bit more restrictive here. But is there really any advantage, at least based on the covenant side of the equation, to even go through the middlemen banks?
You bring up a good point. So typically the way borrowers think about this is you could go to high-yield bonds and leveraged loans, It's cheaper. You get looser covenants, so that's better for the borrower, but you have to take on market risk, right? If you're trying to do a deal, things could change and rates could spike unexpectedly. With private credit, the incentive for borrowers has been it's quick, it's simple, it's a bit more expensive, and the covenants are tighter, so it's less favorable for the borrower, but it's a smoother process. It's just a few people in a room who agree to something. So banks are going to have to grapple with where do these new methods fall in between those two markets right now. And I think we just don't actually have an answer yet. And I think for borrowers, they might scratch their heads and say, why would I do private credit with a bank? I don't want a lot of people involved. Shouldn't I just do it with the private credit firms I already know it with?
The flip side of that, though, is with a lot of these private credit firms here, they've also, I think, found, for lack of a better word, a bit of a runaround around regulatory issues and other things by partnering with these banks in a way where you can sort of either, if not share the risk, certainly offload some of the regulatory issues onto the bank so that you're not necessarily on the hook for that here. Has that become much more of a topic of conversation?
I think regulation is always kind of the shadow overhanging these discussions. The regulation mostly affects the banks because they're just, they have higher capital charges for these kinds of loans. They used to face the leverage lending guidelines, which cap the leverage. And private credit firms, they're just private funds. They're just a specialized type of asset manager. They don't have those regulations. So they could do bigger loans. They could do higher leverage. And I think I'm pretty sure these private credit funds don't want to get mired in some of the regulations banks face if they work with them. But I think for banks, it's kind of the opposite. It's a way for them to not have that risk on their balance sheet, to not be affected by some of that regulation, because most of the risk is being held by this outside partner.
All right. Well, it'll be interesting to see exactly how that holds up, and more importantly, whether credit quality holds up as well. Paula, a wonderful story on the Bloomberg terminal. Encourage everyone to check it out here. A closer look here at the relationship between private credit and the traditional banks here, and some of the swaps that have been going on back and forth. And that really was a big dominant theme, I think, Scarlett, over the last few years here. Just the rise, basically an industry that, I mean, let's face it, 30 years ago was really a few $100 million, and now it is $1 trillion behemoth that is really rivaling the banks in so many ways. And
the talking point was that it was a great industry to go into when interest rates were rising. It was a great place to be when rates were staying higher for longer. Now it's still a great place to be now that interest rates are likely coming down. Banks, of course, are the conduit to individual investors. So I think that's why you're also hearing a lot of individual investors getting pitched on investing in private credit, too.
Yeah, it'll be interesting to see, because I think the other aspect of that, though, is that there is a sort of looser nature to that relationship with the private capital guys, both for the companies themselves as well as the investors as well. Some people like that. Obviously, that comes with a lot of risk.
Absolutely.
But some people actually prefer that. So it'll be interesting to see how that holds up here. A lot more coverage coming up here, including a check on what's happening in commodities. Stick with us. This is The Close on Bloomberg. This is the countdown to the close. Some of the volatility that we saw yesterday in the equity and treasury space being tamped down just a little bit here on this Thursday afternoon. Let's check in and see what's happening in commodities. Abigail Doolittle, she's standing by right now with our commodities close. Abigail.
Well, Romaine and Scarlett, we have a little bit of mixed action here for commodities. Overall, the Bloomberg Commodity Index down just a tad. You can see crude oil down about 0.4%, snapping the multi-day winning streak on the tensions in the Red Sea. The Houthi rebels. Natural gas, on the other hand, reversing its 2 days of decline, now up 4.9%. Coffee yesterday, we had noted that it was the worst day, I believe, since July of 2021. Today, getting a little bit of a bid, but sugar down once again, down 3.25%. Let's take a look at a chart that really puts this into perspective, because sugar right now, this quarter, you can see a pretty steep decline here, down about 28%. This is the worst quarter. Sugar right now heading toward its worst quarter since 2010. It's not entirely clear what's behind this, Scarlett. It looks like some traders and funds are taking profits right now, but something to keep an eye on here as the sugar rally this year is almost dissolved. All
right, and something we'll continue to look at. Abigail, thank you so much. We're going to stick with raw materials here because China is halting the export of a range of rare earth processing technologies. That is according to a document from the Ministry of Commerce in Beijing. The move will make it harder for the U.S. to bolster its supplies of strategic raw materials. For more now, let's bring in Bloomberg national security reporter Nick Wadhams. Nick, what was the catalyst behind this move by China to ban the technologies, the infrastructure to process some of the rare earth minerals?
Well, it's a great question because figuring out what motivates these decisions from the U.S. and frankly for China, is always a bit of a difficult game. But, we have seen the U.S. and China repeatedly sort of go after important sectors in terms of restricting technology. The U.S. has done so, obviously, on chips, reportedly thinking about amping up tariffs on Chinese electric vehicles. So there's a broad campaign being played here on both sides to really limit technology exports to each other, but then also signal, listen, they want to play hardball. I mean, rare earths are such a crucial sector for the United States and frankly around the world, and China's exports of rare earths really are at the very heart of that. So, the way I see this is a bit of a shot across the bow at the U.S. and others saying, listen, we have this very important thing that you need.
Absolutely, and of course we should point out rare earths has always sort of been a bit of a misnomer, as a lot of those minerals aren't exactly rare. However, the extraction process and the technology to produce them is certainly rare. And I am curious as to whether the U.S. has the technological capabilities and, more importantly, the willingness, the environmental willingness to actually refine those things should we be completely shut out from China.
Well, this is one of the big questions that's really forcing the Biden administration to confront. I mean, the fact that the U.S. got out of the rare earth processing and mining industry a long time ago and left that to China precisely, Romaine, as you say, because it's such a dirty business from an environmental perspective. As the U.S. has looked to secure its supply chains and compete more with China, this is something that folks have talked about. But in the time that the U.S. got out of the rare earths industry, the mining industry, China advanced by a large degree in the processing. So it does have technological advances that the U.S. doesn't. I mean, that's not something that the U.S. wouldn't be able to catch up with relatively quickly. But what China's saying here is, hey, we're going to try to slow you down, just like you're trying to do to us on chips. So what you're seeing again is this real push and pull when it comes to trade and technology. And this is just the shape of things to come between the U.S. and China.
And it could have big ramifications here for, I guess, EV adoption, some of the really ambitious targets that the U.S., as well as other countries for that matter, have set. Nick Wadhams down in D.C. covering the national security side here, particularly when it comes to the rare earth minerals that go into the batteries and other components that go into EVs. But in another sign of escalation with China, we've actually learned that Joe Biden's administration is weighing a tariff increase on Chinese electrical vehicles and other goods themselves. That's according to people familiar with the matter, and it is an effort to make U.S. clean energy products more competitive. For more on the state of the EV industry, we're joined right now by Stephanie Valdez-Streety. She's Director of Industry Insights over at Cox Automotive. And Stephanie, it's great to have you on the program. Before we get to what the Biden administration is doing, I do want to talk a little bit about demand, because there was this big push to sort of increase EV adoption. And for a while, it looked like it was there. All the major auto manufacturers were pushing models, or at least saying they were going to push models. But over the last few months, we've seen some of those sales figures, and now we're starting to see some of those companies scale back their production ambitions. Is that EV adoption cycle that we had been counting on, has that been interrupted in any sort of meaningful way?
Yeah, good question. So definitely in the headlines we've seen ups and downs with EV adoption. But if you think about 2023, this is a milestone year. Over 1 million pure battery electric vehicles will be sold. We'll have a 50% year-over-year increase. And yeah, we start to see a little bit of slowdown of adoption and starting to see more inventory, but we're still having steady growth. And I believe that we'll still continue to see that in 2024. As long as we can address some of the barriers, such as price, affordability is a huge one, and access to infrastructure, I think is another one that, as we start to see more and more charging stations in the corridors, I think that's really going to help with adoption as well.
Well, let's talk about one of those barriers. Let's start off with price here for right now, because as we know, the components that go into these vehicles ultimately determines the selling price. And despite some of the best efforts by Elon Musk and Tesla and some of the other auto manufacturers, they have not been able to get those costs down significantly enough. These are still luxury products for the most part, at least in terms of price. And I am curious as to whether you think the production of more rare earth minerals, the production domestically of more batteries and components could meaningfully reduce the prices in a way that these vehicles become much more accessible to a much broader range of customers.
Yeah, I think we're going to continue to see, like we've been seeing the battery prices go down. 2010 to 2021, they went down 89%. Last year they went up. This year they're starting to go down. So I think that's a good sign. And I think around price, I think we're going to start to see a lot more models in a better price range for consumers next year and the following years. So I think that's going to help with the affordability issue. And I also think as we start to see some of these used EVs in the marketplace, that's another opportunity to really bring down that price point. And once again, I think next year, because of the inventory, we're going to start to see, continue to see incentives, discounts. And then one of the other things is the IRA. In January, it's at the point of purchase. So I think if consumers are aware of that and the dealerships are able to really kind of convey the value proposition of EV and sell that to consumers, I think it'll be good for consumers and really trying to help with that price mitigation barrier.
Well, infrastructure is its own issue. As long as people don't feel comfortable that they can get to a charging station, that will keep them from buying an EV. But in terms of affordability, let me just ask an obvious question. Why are Chinese-made electric vehicles more affordable, cheaper than those made by U.S. automakers? Is it, they're using the same materials and the same rare earth minerals, for instance, to produce some of the parts.
Yeah, good question. I think it's more about scale. They've been able to scale, but also just the workforce, right? The scale, the hourly rates. I think if you think about the cost of the workforce to build these vehicles, China has, that lower hourly rates for their workers. So that's really going to help with them to reduce that price of that vehicle that they're launching. But I think in the U.S., if we start to see, there's been this big push to really build out this supply chain in the U.S., this, robust, sustainable, resilient supply chain, and there's huge investment. So I think we're going to start to see that as we start to build up this supply chain in the U.S. I think that'll also help with scalability and also help to reduce the price of these vehicles.
In the meantime, we see a lot, and certainly there are anecdotes to support this, a lot of people gravitating towards hybrid vehicles, which are a kind of good intermediate point between the traditional cars and the EVs because they can still get to a gas station. And Toyota has never abandoned the hybrid model, and more car makers are looking to pick that up as well. Does that slow down the adoption of EVs, or is this a permanent part of the auto market, or is this kind of just the transition point, do you think?
I think it's a transition point. I think, like you mentioned, it's a good transition for those consumers who aren't ready to adopt an EV, whether it's their access to infrastructure, they don't have the ability to do home charging. That hybrid is a good option. So I think, as you mentioned, Toyota, that's kind of been their whole strategy, is this portfolio approach where, they want to offer consumers everything at different types of powertrain costs, whether it's a hybrid, plug-in, pure battery. So I think we're going to continue in 2024 to see hybrids sell really well as consumers have that as an option before they fully embrace a battery electric vehicle.
All right, Stephanie, really appreciate it. Stephanie Valdez-Streety of Cox Automotive. Thank you so much. Let's stay on EVs because China is expecting to reach its goal of having new energy vehicles account for half of all car sales by 2026, which is about 10 years ahead of schedule. However, the EV boom has an unwelcome side effect, which is expired batteries full of toxic chemicals. Bloomberg's Paul Allen has more on how China is trying to tackle this problem.
With the right equipment and know-how, pulling apart an electric vehicle battery for recycling is relatively easy. GEM is one of the largest recycling companies in China and processes about 10% of the country's spent EV batteries. There's no shortage of material for GEM and its competitors to work with. China's EV revolution is helping the country's decarbonisation goals, but also fueling waste. One of the worst examples being the notorious EV graveyards filled with vehicles that quickly became obsolete after they hit the road.
We now pay too much attention to manufacturing cars and batteries, but massive manufacturing will cause massive raw material usage and a large amount of battery disposals, which imposes challenges on later stage processing.
Recovering the cobalt, nickel and other elements in a battery not only improves the sustainability of EVs, but can be a lucrative business as well. GEM has seen its recycling revenue quadruple since 2021 and is on a government whitelist of about 150 key industry players. However, the riches on offer have seen a thriving grey market emerge of smaller players willing to pay higher prices for spent batteries. China's Electronic Energy Saving Technology Association estimates about a fifth of the market is unregulated, lacking the safety equipment to minimise the risk of explosion and release of toxic waste. Policymakers are working on the problem, including traceability around a battery's life cycle. But for now, industry watchers say there's no enforcement to make sure the best practice in China's battery recycling is the only practice. Paul Allen, Bloomberg.
And despite the challenges of dealing with expired batteries, one of the hottest stocks out there is Korean EV supplier EcoPro. It's managed to become the best performing stock of 2023 worldwide. That's according to the Bloomberg World Index, which is basically a collection of about the 2,600 biggest stocks in the world. EcoPro at the top of that list, returning 571% this year, more than 200% percentage points above the runner-up here. And we should point out, they actually spun off one of their materials units just last month, and that stock is up like 200 or 300% last time I checked.
And you know, you mentioned the runner-up. That's another Korean company also at the center of the EV craze. So whatever the case is, Korean investors, retail investors are loving these EV-related companies. The big question is, of course, what happens when the tide turns? And it's actually one of the most shorted stocks in Korea as well.
Yeah, absolutely. Anytime you have that type of hype. And then we should point out that that materials company they spun off, which is basically that supplies a lot of the materials that go into those batteries. I think that was like the second biggest IPO they had this year. I think second biggest IPO since the pandemic, I should say.
What goes up must come down.
So there's a lot of hype around this. But it gets to the point, too, here. There aren't a whole lot of people doing this, Scarlett. I mean, it's still a relatively small group of companies that are doing this at scale, I should say.
Right.
I mean, obviously, there's some players that have ambitions to do this. But right now, there's only so many places you can go. So.
And it's the future, right? It's what everyone is hearing. It's what governments are committing to. It's what automakers themselves are committing to. How long you have to stay in it before it starts to pay off is a different issue entirely.
Yeah.
All right, still ahead, we've got Nike reporting earnings after the closing bells, and investors pretty curious about the company's performance in China. We're going to preview that next and see if Chinese consumers are taking a second look at Western brands. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls. Big movers on the back of analyst recommendations. Salesforce, that's up first. An upgrade to overweight over at Morgan Stanley, and the price target lifted to $350. That's the second highest on the street. Now, while it may take time for artificial intelligence initiatives to fully take off, the analysts expect Salesforce's data cloud portfolio to gain some traction with clients who are preparing for that widespread adoption of AI. Shares of Salesforce up 2% here on the day. Next, let's take a look at Cheesecake Factory, raised to outperform overweight Wedbush. Now, this is primarily a valuation call, but the analyst is saying that the restaurant's estimates for same-store sales growth appear realistic, and he's hopeful that falling interest rates will relieve some of that outsized pressure on valuation that we had seen this year. Those shares higher by about 1% on the day. And finally, let's take a look at Royal Caribbean. Argus Research lifting its price target to $142 from $95, with the analyst saying that the cruise line company has recovered, and more importantly, it has sustained that recovery and that strong demand in a post-pandemic environment. Fuel prices are now down, and the promise of new ships over the next 12 months, painting a rosier picture for the shares. And those shares having a pretty rosy day, up about 4.5%. And those are some of our top calls. All right, we want to pivot now into the retail space because we are awaiting earnings out of Nike. Those are results set to hit the wire after the bell tonight. We'll have full coverage when that crosses. But let's get a preview now from Adrienne Yee. She's Barclays U.S. Senior Retail Analyst, and she has an overweight rating on Nike shares. All right, Adrienne, let's start off here with the growth story because I'm taking a look at estimates for revenue growth, flat. I'm taking a look at estimates for EPS growth. That's flat here. Is there a growth story that we might learn when we get the results later tonight?
So what's happening with Nike right now is what's been happening with all of the other kind of wholesalers before them. Remember, Nike's kind of inventory issue was delayed, right? They had the most exposure to the Vietnam shutdowns in the back half of 2021. So this is the worst quarter of growth. And so from this point forward, this is a wholesale kind of destocking quarter that they're up against. Things should get better. So it's not going to be on this quarterly print, even though we think they're going to beat the quarter on EPS. But it's going to be about the forward story, the recapture of the margins. And then, as we always say, when you are cleaning up the inventory, it's very difficult to have sales growth be robust and earnings growth. So you're going to get margins before you get sales growth. That's more of a fiscal 25 story.
Okay, that's great that you really break it down like that. So if this is a forward-looking story here, what do we know about the management at Nike? Are they more likely to be conservative when speaking and discussing what they expect, or are they more likely to be aspirational in their guidance?
They're somewhere in between, actually. They are realistic. That's the word that I would use. So the things that they have really good visibility on, they're very confident on. So, for example, they said last quarter the input prices were actually going to reverse from being a net headwind in this current November quarter, and they were going to start becoming a tailwind in the February quarter and beyond. They also talked about sort of having visibility further out into the calendar 2024 when the marketplace would normalize. And what that means is that they stop destocking, right? Mm-hmm. And the frontline retailers start to replenish. And we very much think there's going to be a replenishment cycle in the back half of calendar 24.
What about the replenishment cycle in China? Because that's the big market that has a question mark hanging over it.
So China is probably in a situation, declining sales, macro overhang, not great consumer sentiment, that the U.S. was in at the beginning of, the calendar of 2023. Huge uncertainty, lots of macroeconomic pressure. And so China's at the beginning of that kind of uncertain cycle. What you can do in that kind of uncertain top-line environment, you can keep the inventory clean, you can generate newness and innovation. In fact, in China, we are looking for them to maintain their low double-digit, possibly kind of, low to mid-teen in that region. We are seeing that the recreational nature, right, people still want to recreate, and that's very much in Nike's wheelhouse.
Does this get to the idea, though, too, when we talk about Nike's international expansion, and particularly its expansion into China here, that we could see a reacceleration of that growth that got interrupted, really not because of marketing, but I seem for a lot of the geopolitical issues?
Yeah, what I would say is Nike at this point in time has a lot of recovery in many of its regions, not the least of which, right, is the U.S. market. I think if we start to see or we hear from them that this is the worst of the wholesale U.S. destocking, that's a net positive. If we hear that the DTC, the direct-to-consumer channel, is growing a little bit faster than mid-single digit or should grow faster in the future than mid-single digit, that's a positive. And then the China piece of it, as you say, Romaine, I don't even think it needs to accelerate much from low double digits. It just can't decelerate. That's the issue here. I think the stock underwrites kind of low double digit, kind of, range bound China with a lot of uncertainty, but better margins.
All right, Adrienne, one of the best in the business. Always great to talk to you. Adrienne Yee over at Barclays, giving us a preview of Nike earnings. We will have full coverage of those earnings, Scarlett, after the bell tonight here. The Street basically looking for about 85 cents on the EPS side on the back of about $14 billion in revenue. Yeah, the revenue growth being flat is the key part here. And I like what Adrienne said about look for margin expansion first before you see any pickup in top line growth. The big question is, what does spending look like during the holiday season? I just went on the website, 50% off. Perfect for someone like me. Yeah, I have to tell you, I mean, I buy from Nike a lot directly from the website, and I've noticed an increase in promotional that they've been sending me. And obviously, that's just anecdotal here, but I felt like a couple years ago, you never really saw meaningful sales. I mean, it was always like, that crazy colored shirt that nobody would buy and a size extra, extra small that they would discount. But, you couldn't find anything in your size. Or something on Amazon, and you weren't really sure where they were getting it from. Oh, yeah, you can't buy on Amazon with Nike. No, Nike not anymore. Yeah, they said basically if you see it on Amazon, it's probably either fake or it's just some sort of It's just dodgy. You should just avoid it. Some dodgy thing. Anyway, we will have that full coverage of those Nike earnings after the bell, 4 p.m. Eastern time. But stick around here. We're rounding out into the final hour of trading here on this Thursday afternoon. The price action, a lot more positive than what we saw yesterday afternoon. Romaine Bostic and Scarlett Fu counting you down to the close. This is Bloomberg. As we round out into the final hour of trading here on this Thursday afternoon, stocks trying to claw back some of the losses from yesterday, Scarlett. We talk about that big downdraft, some of it being blamed on some of the options activity here, but there was a broader fundamental question here about what was effectively a 7-week rally and whether it had gone too far.
Right. We went from oversold to overbought in a really quick time inside of 1 month, and then we stayed overbought for an extended period as well. So it was just a matter of time before something triggered a reversal, and we got it in spades yesterday, and it does look like, well, we're not going to be able to make that record high, at least today, unless we have a really big rally between now and 4 p.m.
Well, most of the folks on Wall Street looking to a higher end of 2024 for the S&P 500. What does the end of 2023 bring? Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Scarlett Fu.
Let's take a look at the broader market, Scarlett. We saw yesterday that big downdraft in the market, seemingly driven by options activity and maybe just a rethink of valuations, trying to claw back some of those losses today with the S&P up about 0.6% and the Russell up more than 1% here on the day. And then you take a look at what's going on in the yield space. 389. It's still kind of wild to look at a 10-year yield at 389, considering I felt like a few months ago we were actually talking about the potential for it to hit 5.
Yeah, especially since late October, right? The move has been massive. You included Bitcoin here. I mean, it's vacillated a lot of late, and all the talk about a Bitcoin ETF that has not come to pass, it feels like people just want to make a wager somewhere.
Absolutely here. And before we move on to some of the individual movers, we just want to bring you some breaking news. This involving Apple and the drama over that patent loss on the Apple Watch. We're now learning that Apple has pulled all of its watches from its online store in order to meet this ban. This was widely expected after reporting over the last couple of days about it losing that patent case and now having to find some workarounds here and to being able to continue to sell these watches.
But apparently, if you can find it at a Best Buy, you can still buy it. It did not apply to third-party outlets. So if you're desperate for that Apple Watch, it's still available. All right, let's take a look at some of the individual movers. We'll start with Carnival Cruise Lines, up as much as 7.9%. The cruise line company reported a smaller than expected loss. It gave guidance for this quarter that is better than expected. It may prove to be conservative if currency and fuel prices stay where they are. And of course, it gave a lift to the other cruise line operators like Norwegian Cruise Line and Royal Caribbean as well.
This is one of those other kind of contrarian calls, too. We talk about all the people who got the recession calls wrong. Remember, everybody said the cruise lines were basically going to circle the drain because of the pandemic. And then as soon as they were able to get folks back on the ship, everybody went en masse. And, and there was like a great joke, at least in my family. I have some cruisers in my family, and nothing stops them from getting on a cruise. I don't care how bad the pandemic is. There could be a zombie plague, and they would still get on a cruise.
Right. Remember all those, stomach flu issues, and none of it stops them, right? All right, let's take a look at the chip space because Micron, which of course we gave you the breaking news yesterday on its earnings, has its biggest rally in 2 years, giving a strong revenue forecast, data center demand more than offsetting the slow recovery for PCs and smartphones. I guess the narrative is firm that Micron is through the worst of the industry slump.
Yeah, absolutely. And the results actually really weren't that bad. I mean, we saw the knee-jerk reaction yesterday, but you see the upside today. I saw you had Paycheck on there. We don't talk about this company a lot here. Are we not getting paid anymore? What's happening?
We're getting paid. That's not the issue.
Okay.
Yeah, well, we're sitting here, right? Paychex is it's the worst performer in the S&P 500, down 7%. So it reported a bottom line beat, but a top line miss, and it cited labor issues and costs, which is really vague, and it sounds like it could...
Labor issues. So what does that mean? They have to pay their own people more?
Maybe they thought AI could solve the problem. Not sure.
Okay. All right. I don't know. When I see a Paycheck firm down 7%, I started to get the little heebie-jeebies.
I get it.
It's something very specific to them as we are 1 hour away from those closing bells. Sit tight. Our cross-platform coverage of today's top stories starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Scarlett Fu. We're joined right now by our colleagues Tim Stenovic and Jennifer Ryan. Jennifer in today for Carol Massar. Welcome to our audiences across our Bloomberg platforms, television, radio, originals. And yes, Tim Stenovic, those folks still streaming us on YouTube.
You can't get away from us. We're everywhere, no matter how hard you try. Hey, do you guys remember yesterday we were talking about the high cost of childcare, the high cost of college? Well, I have bad news because it turns out it's even expensive for your kids after they graduate from college and move back in with you. And then you can no longer save for retirement because you're supporting them.
Okay.
I'm being serious. There's a story on the Bloomberg terminal today. It's a great story by Suzanne Woolley and Paulina Cachero. Great story as in it's well reported and well written. Not great as in great news for what's going on in our economy right now. It turns out that U.S. parents are spending about $500 billion every single year on their 18 to 34-year-old children. That's double what they're
34?
putting away toward
That's not
retirement.
a child anymore.
Yeah,
They're
well,
always your child, unfortunately. I mean, more fortunately. In terms of financial support, they're
Let
always
me
your
rephrase
child.
that. At 34, you're not going to be my dependent. How about that?
that's according to estimates from a Merrill Lynch
I'm not
and
sure at
Age
19
Wave
you're going to
study.
be my dependent, but that's a whole nother
Look at this, though. I mean, it's got some serious economic implications, Jennifer.
Yeah.
Yeah, it does. And one thing that's very worrying about this is that we already know that Americans don't save enough for their retirement. But this story is full of really interesting anecdotes, and one of them shows that really nothing changes. This one woman's got her children living with her, and she still can't really control their spending because one of them went out and bought a sports car.
Oh, God.
Don't
Yeah,
buy a
this
sport.
is like a parent's worst nightmare. And of course, with the housing market the way it is, right? There's no supply out there. Mortgage rates are sky high. No one's going to be able to buy a house. Even if they wanted to form a household, they're not able to. So they're going to live under your roof forever.
Yeah. Okay. It depends. It depends on the family. I mean, my mother made it clear to me that, once I graduated from college, that was it. That the gravy train stopped there and I was basically on my own. You got to just nudge them out of the nest. You can't be afraid.
Yeah.
Gotta fly. They got to fly on their own.
Fly away on your own. I think easier said than done for a lot of people. But yeah, I think, you know what, Romaine? I'm going to subscribe to that rule. I know my kids
Tough
are young
love,
now.
Tim.
Tough
That's
love.
going to save the
You have a
economy.
couple of years, Tim, to get your bearings straight in terms of how you're going to present this to your kid.
Tim, you got like 15 years to figure this out.
When do they start earning money? That's what I want to know.
15 officially, but maybe you can
Depends.
start
I don't
them
know. In some
earlier,
states,
right?
you can start them working at like 10.
All right, good to know.
Hey, you guys, there's another story that I found really interesting, which is in Sweden, they're really pressing for calls to reduce the number of trading hours for the Swedish exchange. The traders there are saying that it's really getting in the way of life. They trade for 8.5 hours, which is 2 hours longer than the trading day here in the U.S. It's, an issue for working moms especially, and certainly there's lack of work-life balance. They don't get a break for lunch hour, for instance. And I know that we don't get a break here in the U.S., but we also don't start trading until 9:30 a.m. and we stop at 4.
And we have to work during the month of August, unlike people in Sweden. So.
Oh, you can go back to like the early days. I remember like in the early days of, what was it, down by the buttonwood tree or whatever they called it, which is probably just a myth. But yeah, I mean, didn't they like trade for literally like 30 minutes a day or something back then? And then somehow we expanded to 6.5 hours here in the U.S. and whatever they're doing in Sweden, 8.5. What are they trading in Sweden for 8.5 hours?
I was shocked
Volvo?
to see.
No, Volvo's not traded there.
But then
It's like a Chinese company now, I think, isn't it?
Yes, exactly.
That's good.
Yeah.
Yeah, you sort of wonder, though, what's the upside of being open for so long? Because surely that must make for some very choppy liquidity situations.
Yeah, that's a really good point.
I wasn't joking about my August comment. I went to Sweden in August a few years ago, and my Swedish friends were like, why did you come here during August? Nothing is open because everybody's on vacation. Literally, the entire country goes on vacation during that month. We still had a great time. Highly recommend the trip.
Yeah, I think most countries do that other than, one that shall remain nameless.
It's just us. It's just us.
Well,
All right,
apparently we did all go out on vacation in August, or at least we stayed around here and spent a lot of money.
I'm going on vacation tomorrow.
What?
But it's okay.
Are Carol, both
It's
you and
okay.
Carol allowed
Yeah,
to vacation
we're both
at the
out.
same time?
We're not allowed to. We're doing it, though.
Oh, okay.
She's not on vacation. She's
Okay.
recovering.
From vacation.
But don't worry, because before I go on vacation, we're going to be back here in less than an hour for our Beyond the Bell coverage right here on Bloomberg TV, where we take you through today's market close on Bloomberg TV, on Bloomberg Originals, on YouTube, and of course on Bloomberg Radio. We'll see you in just a bit.
And we continue our coverage right here on Bloomberg Television, counting you down to the close, which is just about 50 minutes away. Joining us right now is Rob Waldner, Invesco Chief Fixed Income Strategist and Head of Macro Research. Rob, great to see you again here. Let's start off here. I do want to start off in the fixed income space because that kind of was the tail wagging the dog for a good portion of this year, whether it's what was going on with treasuries and the Fed rates or even what we saw going on or maybe not going on with credit spreads and in the corporate bond market here. Do you anticipate that 2024 is going to look a little bit different in terms of the complexion of the trading activity we see in that space?
Thank you, Romaine. 2023 was quite a ride for fixed income. right? We saw rates go all the way up to 5% and come back down to where we are now. And it's really been driven by these narratives that have gripped the market around inflation or around recession. And, we think that we're now priced for what is, we think, a reasonable base case, which we think the data really is pointing to this kind of bumpy landing, as we've been calling it, a disinflationary bumpy landing. And if that comes to fruition, the market's priced pretty well. That being said, there's, of course, a lot of risks out there on both sides. But, we think the market's priced pretty well. So turning to 2024, your question, we still have some good yield in the market. But it's going to be, valuations are looking pretty stretched. So if you look at credit, I don't know how much you've talked about this recently, but credit spreads are quite tight. Overall level of yields are obviously lower. We're at 3.8, 3.9 in treasuries. And so we're less likely to see the big rally in 2024, but we think it's more of an environment of really collecting that carry and grinding higher.
Yeah.
And we do expect that this current environment of this bumpy landing will persist, which should be supportive for the fixed income market.
This gets to this idea, though, too. I mean, the fixed income market, for a lot of folks, is really the only game in town. If you wanted, at least on a total return basis, if you wanted whether to lock in a yield or even just take advantage of some of the price return, you did pretty well, at least if you were tactical enough about it. But that was also because you didn't have as much competition coming out of the broader market equity space. And it feels like that's changing now. You're starting to see that equity premium get priced back in here. And I'm wondering whether that's going to focus more people to move cash or reallocate, I should say, reallocate cash out of some of those fixed income investments and into something else.
It's a great question. I think that it certainly, with the drop in yields, it does maybe mean there'll be some more allocation out of fixed income. But the big story, Romaine, is the money market funds, right? And we have huge balances, 3.8 trillion or so of money in money market funds. That is really, I always say, money market funds are risk-free, except they have reinvestment risk. And once the Fed is starting to cut rates, that money will probably start looking for a new home. So that flood of money will probably offset any rebalance you get between fixed income and equity.
So once the Fed starts cutting rates, that money will start looking for a new home. But of course, prices move in anticipation of the Fed cutting rates. How much are you at risk of, falling behind that reinvestment risk that you're talking about if you are an individual waiting to get in and waiting for the all clear from the Fed?
Well, just look at what's happened in the last quarter. Investment grade bonds. So the Bloomberg Investment Grade Index is up something in the order of 8% in this last quarter since the end of September. Of course, the equity market's done quite well. So when people start to get their quarterly statements or monthly statements, I think that's when you start to see, there are these other alternatives that have actually done pretty well. And that's probably what causes some of those conversations, Scarlett.
And of course, I got to ask you about the Treasury issuances, because that had been a huge dampener on the Treasury market over the past couple of months. As the Fed moves forward with looking to keep rates where they are and eventually cutting them, do you anticipate this to be something that's going to hold back Treasuries and therefore the rest of the credit market?
We should really see this curve steepen. I think that's the bottom line. So that this issuance will likely hold back longer-term treasuries, in our view. Well, so when the Fed cuts, we would expect to see the curve steepen.
All right. Really appreciate your joining us today. Rob Waldner of Invesco talking to us about fixed income here. All right, we've got a lot coming up on the close. Media giants Paramount and Warner Brothers Discovery are in talks on a possible combination. We'll have the latest on what a potential deal could mean for the streaming industry. Everyone's been saying it's long overdue for some consolidation.
Plus, the new space race, why the company that dominated Pentagon rocket launches long before SpaceX ever even came into the picture may actually get a new high-profile billionaire owner.
We'll tell you who it is. And as we head towards the close, less than 50 minutes to go before the closing bells, we're going to get insight from the markets from Bob Elliott. He is CEO and CIO of Unlimited. This is the close on Bloomberg.
As the clock ticks down, about 44 minutes until we get to the closing bells, a bit of a reversal from what we saw yesterday with that big sell-off. Now, the gains today, not necessarily enough to claw back all those losses from yesterday here, but when you look at the names that are higher on the day, some welcome relief. Netflix up about 4% on the day. Bank stocks continue to rally. Bank of America up 4% on the day. In fact, that's shaping up to be one of the best stocks on the week. And if you're looking for movers to the downside, it's much more the idiosyncratic stories here rather than something that's broader and systemic to the market. You put it all together, a 0.6% gain on the S&P 500, similar gains that we're seeing on some of the other indices, and outperformance once again in the small and mid cap space. You see that reflected in the Russell. You see that reflected in the S&P 400 mid caps. You see that reflected in healthcare. And don't forget, well, even some of the big cap names, Philadelphia Semiconductor Index back above that 4,100 level, a 2.4% gain here on the day. Some idiosyncratic stories to keep an eye on. Of course, everybody really focused on Warner Brothers Discovery and Paramount on the back of those reports that there had been a meeting at some point this week here between the heads of those two companies about a potential merger. Micron earnings yesterday and Nike earnings coming after the bell tonight. But of course, all the talk still remains about, well, what exactly happened yesterday? Let's bring Abigail Doolittle into this conversation for our Options Insight segment. And Abigail, you're taking a look at yesterday's sell-off and really the role that options and those short-dated options played in that sell-off.
Indeed, Romaine. There's a lot of talk that those zero-day to expiration options were a big piece of that fast sell-off with the S&P 500, essentially losing 1.5% within about an hour and a half or so. I cannot think of a better person to be joining us to talk about yesterday's sell-off. Not so much for those options in terms of those zero-date, but just from perspective. I'm pleased to say that Dennis Gartman, former editor of the Gartman Letter and chair to the University of Akron's Endowment Fund, is with us today. And Dennis, great to have you back with us. And you have seen so many different markets, so many different cycles, so many different rallies, so many different sell-offs. What happened yesterday? What does it remind you of?
It reminds me of what happened late in 2021, just before when we took the CNN Fear and Greed Index above 80. We've had the market extremely overbought, unbelievably so, as wildly overbought as I've seen in the 50 years that I've been involved in markets at any one period of time. And I do think that as you were talking about, the zero-day options had a lot to do with the fact that we broke as substantively as we did yesterday. I do pay attention to what I call outside reversal days, when we made a new high in any market, whether it's corn, whether it's crude oil, whether it's cotton, whether it's stocks, whether it's bonds. When you've gone to a new high and then closed below the previous day's low on large volume, you need to pay attention to that fact. They usually mark the tops of markets. I've missed the rally from October to early in this, through the rest of December, but I think that we've seen an outside reversal day, and I pay attention to that. The fact that we have not taken back all of what we lost yesterday is important. We'll see how we close today, but I think that the options market had a lot to do with yesterday, and you had an outside reversal day. I pay attention to those.
Yeah, today's buy the dip action is not so robust, and it's really interesting that you're bringing up 2021. I was speaking to Steve Sosnick this afternoon, and he was saying the same thing, that he thinks that this is very similar to 2021, 2022. I was earlier thinking about how the recent rally reminds me of bear markets, which I know is counterintuitive because we've been going higher, but the S&P 500 has actually not taken out its high, which is interesting. It does look like it's in a small topping pattern, at least for the near term. Do you think that we're setting up for some kind of bearish action in the beginning of 2024?
I do think we are going to set up. I think we are in the process of setting up for a bear market. Time shall tell whether I'm going to be right or wrong. Like I said, I had been wrong since late October. I was right for most of this year, but wrong since late October. But the fact that we've had an outside reversal day, as I said, I pay attention to those things. I pay more attention to outside reversal weeks and outside reversal months. You're not going to get those, but you had an outside reversal day. And again, pay attention to that fact. We went down yesterday on very large volume. We're about rebounding today on light volume. We should expect light volume. It's a holiday for all intents and purposes. But we need to watch how the market responds, whether we continue to go up on light volume. And as I said yesterday, we fell on very strong volume late in the day. So that's, to me, a precursor of what I think shall be a bear market starting in 2022. It reminds me very much of late 2021. When we made a high in the last couple days of the year, made a high actually in the first day of the 2022, and from then on had a very substantive bear market. So as I like to say, be careful out there.
And, you know, I know that you love to follow price. It's the most reliable indicator that you can possibly follow. But if you were to put a what with it, the fundamentals of a bear market, what are you thinking about?
The fact that I think that the market has anticipated a Fed that's going to be easing monetary policy far too quickly. I don't think the Fed intends to cut the overnight Fed funds rate more than 100 basis points, and it's going to take late in 2024 before we see the Fed move any at all towards a lower Fed funds rate. I think we have anticipated, 175 basis points in the course of the year. I think at most we'll get 100 basis points, and we won't even start to see it until late in 2024. So be careful.
Yeah, that disconnect between the Fed and markets, the Fed dot plot showing 3 cuts, the market's right now 6. That does seem like it could create some air pocket problems. Dennis Gartman,
Yes.
former editor of the Gartman Letter and chairman to the University of Akron's Endowment Fund, thank you so much for joining us for Options Insight today. And from New York, this is Bloomberg.
Investment bankers, at least some of them, will have to wait a little bit longer before they get word on what their bonuses will look like. Barclays has delayed the final decision on its bonus pool to early next year. And this is because Romaine top investment bankers there say M&A and other activity, it's been picking up and they want the bonus pool to reflect this new business. If they just decided on it now, it wouldn't encompass all of that.
Well, they're not wrong. I mean, the Bloomberg data kind of bears that out, at least in aggregate, that we have seen a significant pickup here. But I was confused because when I saw the story, I was like, why wouldn't they normally take that into account? Is there like a cutoff where they basically say anything that happens in December doesn't take anything? Because then I would just, you talk about taking off for August and you just take off the month of December if you're not going to get paid for it.
Well, I mean, the bigger problem is that it's been very slow on the M&A front for most of this year. And now it's starting to percolate, it's starting to pick up at the end of the year. And so they are trying to make sure that that gets reflected to make up for the fact that it was kind of slow for the rest of the year.
I was being a little facetious. Obviously, there's a lot of rollover into that. So, I mean, it's not like they would lose the money. It would just kind of go into the 2025.
Yeah, but that would delay
bonus.
your moving on to the
right,
next
but
firm.
exactly, and that's really what this is about. But it's also really about a retention as well here. And we know there has been a huge competition. We were having a debate a little bit earlier about private capital and the relationship with banks. And I mean, how many folks have we seen leave the more traditional side of finance to go into private capital because, quite frankly, you're just going to make more money.
Yeah, and there's no regulators staring at you, going over your numbers, checking your phone, checking your records in the same way that the SEC does that right now.
Yeah, so it'll be interesting to see how these banks adjust to the new environment and how they sort of structure compensation in a way that keeps people happy and, more importantly, keeps them there.
You wonder if any Barclays traders are not going to go away on vacation at the end of December to make sure that all this new activity gets folded into their bonus pool.
Well, we'll see. I don't know. They only got a week and a half or so left.
A lot
in the
can
year
get done.
here. And this is all mostly investment bankers too. So I don't know. I mean, they're always a pretty fickle bunch anyway. Do they even come into the office anymore? I feel like
they're supposed to be chasing down clients and shaking hands and meeting face to face. So
yeah. Some of my best friends are investment bankers.
Are they going to the office?
No.
All right, that does it.
I don't want to get anyone in trouble here. All right.
What do we have going on here?
We're checking on the markets here. About a half an hour to go here in the trading day. Stick with us. Yeah, it's a rally, a modest rally here. He hasn't gotten back all the losses from yesterday here, but definitely a certain welcome rebound here, even if the volume is a tad light. We'll be back in a moment. This is a close on Bloomberg. This is the countdown to the close. Just about 30 minutes until we get to the end of the trading day. And Scarlett, 24 hours ago when we were standing here, the narrative and the price action was a lot different.
Yeah, it's absolutely the polar opposite. That's where I was going. From what we saw yesterday, the S&P 500 is now back on track for its 8th straight week of gains. And you see a lot of green in the pie here for the S&P 500, split up into 11 industry groups. What you have is consumer discretionary leading the way, and that is really the Carnival Cruise Lines and the Norwegian Cruise Lines getting a big lift after Carnival reported earnings. Healthcare also up by better than 1%, and tech is largely higher as well. On the downside, you only have one group in the red remain, and that is utilities, energy, little change right now as oil prices vacillate.
Yeah, yesterday we had about 95% of the S&P 500 members were to the downside. Today, about 85% of them to the upside here. And you take a look at some of the names behind me. Cintas here, their biggest mover in the third biggest mover in the S&P 500 today, a 6% gain. That's actually the strongest day that this company has had going back to 2020. And if it holds at 588.93, that's going to be a record high. Of course, this is the company that makes basically uniforms and other things for the workplace here. The analysts really sort of lauding the company's earnings report, saying that the diversification that this company has taken over the last few years has really helped it weather some challenging times here. Meanwhile, CarMax trying to get its mojo back after a huge downdraft in that stock over the past few months, a 4% gain today on the back of its earnings report that was really encouraging, particularly when it came to its forecast. Meanwhile, the flip side of that was BlackBerry. Always that quarterly reminder that yes, BlackBerry exists, and yes, it's still a publicly traded company. Shares down 13% here. Worst day for that company going back at least to September here, and that's because they gave a forecast for revenue that really came in well short of what the street was looking for. Now remember, this isn't a device company or even a mobile company anymore. It's largely about cybersecurity software, and there's a lot of competition in that space right now, and they're really trying to find a way to carve out a niche for itself in that space. And more earnings coming after the bell tonight. We were just talking about it a little bit earlier, Scarlett. Nike set to report after the bell, full coverage right here on Bloomberg when that crosses.
And of course, we'll bring you that when it crosses. I just look at BlackBerry and the ticker BB, and it seems so weird. It should be RIM, R-I-M-M. All right, coming up, the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg. It's time now for the top three. Every day at this time, we take a deep dive into the people at the center of the day's top stories. And I'm going to get us started because I'm watching another Harvard alum turned donor revolt against the school. Len Blavatnik has given at least $270 million to Harvard through his family foundation, but he is now hitting the pause button on further gifts. Of course, and this comes after the congressional testimony by Harvard President Claudine Gay and her counterparts at Penn and MIT that went viral because they were very carefully lawyered statements to questions about anti-Semitism on campus.
Yeah, certainly something that the president there, and more importantly, the finance folks are going to have to navigate here and try to deal with some of those issues. I've been keeping an eye on someone else in the news here, and that's Jeff Bezos. We know he's had a lot of ambitions to I guess, go to space, more as tourism. Of course, they made a big to-do when he was launching that really weird-shaped rocket and launching people up. But underneath,
distinctly shaped rocket.
But thank you. I was trying to be diplomatic. But underneath the hood there, beyond the tourism, there is a legitimate business here in launching satellites into space. And the Wall Street Journal is reporting that Bezos, along with private equity firm Cerebras, is looking to buy United Launch Alliance. Now, if you've never heard of them, shame on you, but this was basically the only way to get rockets into space up until a few years ago when SpaceX came on the scene. This was a joint venture between Boeing and Lockheed. They own it 50%. And we know for years it's been kind of on the block. Back in 2015, we know that an unidentified buyer had offered $2 billion for it. We don't know why that was turned down. And the Journal is reporting now that at least two buyers are now interested in it, including Bezos and Cerberus and another company called Textron. They're saying that the valuation at minimum could be around the $3 billion mark.
So maybe it was worth waiting around until this happened, right? The space race used to be nation versus nation. Now it's billionaire versus billionaire, or billionaire group versus billionaire group, because Cerberus is led by Steven Feinberg, another billionaire as well. And Bezos, of course, making his bid through Blue Origin, his space startup. And as for Boeing, it's getting out of the space game entirely?
No, well, we should point out, this gets down the rabbit hole, but they have a whole nother project they've been working on with Lockheed for a new type of sort of a space program that is independent of what ULA is doing. And I think they're just putting their chips into that basket rather than continuing to keep ULA going.
All right, and our third person that was
he's not going to wear that hat if he bought. Oh, who bought him that hat?
I don't know. That's an interesting hat, but everyone needs something distinctive when they go to space. Because that's the picture
why?
that lasts.
No one's up there, though, in space.
No, but you take pictures before and after and during it. You have selfies. So that's what everyone sees later on.
At least he has a name tag on his thing, so when the aliens do find him, they know who he is.
That's why they wear name tags on their spacesuits?
I don't know. Maybe.
Right.
That's the story I'm sticking with.
Let's get to our third person. He is Gary Gensler, chairman of the SEC, and this is after the U.S. Court of Appeals for the Fifth Circuit threw out the agency's rule requiring more information on stock buybacks. The appeals court said the SEC did not properly weigh the costs and benefits. So the SEC originally wanted to shine a light on opportunistic buybacks, but the court called its rules arbitrary and capricious.
I'm sort of confused by Gensler, to be honest with you. I mean, when he came in, when he took over as SEC chairman, there were a lot of promises about all these regulatory overhauls, many of which we still haven't seen. He hasn't even put the cards on the table. The few that have come on the table have faced legal pushback as well as lobbying pushback, and at least based on this one as well as a couple others, they're not necessarily doing too well at winning in terms of the SEC themselves. So I kind of wonder where all this is going, particularly given that the current administration has at least one more year, maybe they have more, but one more year basically to get anything done if they're going to do anything.
Yeah, well, the timeline is getting shorter for Gary Gensler to make an impact, right? Let's bring in Bloomberg law reporter Anna Yukonanov in D.C. to give us a little bit more on Gary Gensler, because as Romain pointed out, Anna, since he took over the SEC in April 2021, the agency has been dealt a number of legal setbacks. This is just the latest one, and it calls into question what happens next with some of the other SEC initiatives.
Yeah, it's a great point. I mean, the Fifth Circuit that threw out the stock buyback rule in general has been seen as a more conservative circuit and very skeptical of anything they view as agency overreach. So they've thrown out this rule. They've been a lot more careful around other SEC proposals because they say the agency isn't doing a good job of weighing the costs and the benefits of these rules.
I am curious. I mean, I know it boils down to that cost-benefit analysis, but was the SEC not able to make a case about market stability and I guess the general protections that Gensler has been advocating for, independent of just cost-benefit?
I mean, the question is, how do you measure things like concrete costs, forcing a whole bunch of businesses to report every single one of their stock buybacks every single day versus something a little bit more abstract like market transparency? How do you put that on a ledger? And I think that's what the SEC is really trying to do. I mean, they had what their justification was, but the court didn't find it persuasive.
Yeah, the court didn't find it persuasive. So now I don't know if it's back to the drawing board for the SEC or they kind of give up on this and move forward with the rest of Gary Gensler's long to-do list. And one of the items on his to-do list is some much anticipated climate rules. Can you tell us a little bit about that and whether that already faces opposition?
Yeah, I mean, the business lobbying against the climate disclosures, this is public companies having to report their greenhouse gas emissions, has been intense. And the SEC is taking a lot longer with the rule than people were expecting, especially among environmental advocates. So the worry is that they really have to go back and make sure that those costs and benefits are going to stand up to court scrutiny, especially if Biden has to leave after November, and this rule is going to be subject to a lot more legal challenges.
All right, Anna, great to catch up with you here. Of course, the big story that we've been talking about here is the SEC stumbling on that stock buyback thing after a court ruling working against Gary Gensler there. One of the big stories of the day. Another developing story out there right now is what's going on with Apple. We knew that it had run into troubles regarding a patent involving its Apple Watch, and now we've learned that it has officially stopped selling the Apple Watch Series 9 and Ultra 2 in the U.S. in the online store. The move comes just days before that ban related to that patent dispute takes effect. Bloomberg's Ed Ludlow joining us right now. Talk a little bit more about this. And Ed, so basically if I want an Apple Watch over the next couple of weeks here, am I going to be able to get my hands on one?
Yeah, your time's running out. As of 43 minutes ago, you cannot get the Watch 9 or Ultra 2 on apple.com or its website. And then on Christmas Eve, December 24th, Apple will pull the Series 9 and the Ultra 2 from all 270 of its retail locations or stores. And, you know, the issue actually runs a lot deeper than that because the ITC found a specific breach of 2 patents for blood oxygen. And if you look at all the models that carry that technology, you're going back all the way to 2020 And so what Bloomberg's reporting on top of all of the store pools is that after December 24th, basically you can't swap in a watch that's broken.
Well, I'm curious about something. I mean, they made a big deal about this feature when it came out, the VO2 or whatever you call it, and the blood oxygen stuff. Is the fix, though, or what's being violated, or what the ITC at least said was being violated, is that a hardware component, Ed, or is that a software component?
It's both hardware and software, and it's kind of a David and Goliath story, because what is the remedy? Either they come up with a completely unique technological fix, or the story with Massimo, remember the CEO was on with our own Caroline Hyde this week saying he's open to settling, and one outcome could be Apple just licenses the tech from Massimo, costs them a few dollars, and for Massimo, that must be some pretty nice high margin revenue that they may not have been expecting.
Right. So, Ed, the other issue here that Apple needs to contend with is if customers have any other issues with their Apple Watches on these models that violate this patent, they are not able to go get it repaired. Is that right?
Right. So basically, Apple is halting watch replacement on any Apple sold since 2020. So it's not just the 9 and Ultra, but it includes the 6, 7, and 8 generations as well. And as we just discussed, those have the blood oxygen features as well. So the long and short of it is that any customer who is in possession of that older generation after December 25 isn't going to sort of be able to swap them out, which is kind of standard practice in an Apple store if you have a broken item. And getting it replaced or even fixed is going to be a really big problem.
All right, Ed Ludlow joining us right now to talk a little bit about what's been going on with the saga with the Apple Watches, which could soon be pulled from the shelves because of that patent dispute.
It's a PR black eye for Apple, which does this so well, all the PR and the optics and everything.
Yeah, can I just say, too, as somebody who actually uses this feature, it's not very good. And I do wonder, and I don't mean that as a diss, but I do wonder if there maybe is sort of maybe some calculation going on behind the scenes as to whether they want to pay this or maybe just redesign the watch in a way that
but the headlines aren't good, especially
when
But
I agree with you. It's, maybe they should have just paid this guy at the outset. Stick with us. Bob Elliott, CEO and CIO of Unlimited. He's on deck right here on The Close on Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Scarlett Fu. We're just about 10 minutes until we get to the closing bell, Scarlett. A bit of a reversal from what we saw yesterday. In fact, a huge reversal now, just taking a look at the market here. We're at session highs.
Yeah, in the last 40 minutes or so, the indexes have gone straight up, and the Russell 2000 up by 1 2/3%, the S&P 500 up almost 1%. Like you said, a complete reversal of what we had yesterday. And for the S&P, if we hold on to these gains, and it looks likely that we will, this would be the 4th gain this week. And of course, yields are also on the move, but you could see it's in a reversal of what we had yesterday as well. The 10-year yield moving up to 3.88%. And if everyone believes that the Fed will cut rates and cut it rapidly, that means a lower dollar, and that's certainly what you're getting right now.
Yeah, a lot of people really trying to price around that right now. Here, let's get some insights out of Bob Elliott. He's the CEO and CIO over at Unlimited, joining us in Studio 2 here in New York. Great to see you, Bob.
Good to see you.
And let's pick up where Scarlett left off here, because, of course, a lot of the rally that we've seen, or at least the latest leg of the rally, was fueled by the Fed decision, which was more focused on that dot plot and really the forward guidance, which was basically that, yeah, we are going to cut rates, maybe not as much as the market wanted, but the market really took that baton and just ran with it just down the road.
Well, I think a lot of what we're seeing in the market is that the bond market, and particularly the short rate market traders, are not necessarily believing the Fed's reaction function that they've outlined in the dots. They're saying the only reason why we have higher for longer rates right now is because inflation was elevated, and in many ways implying that just because inflation now is in the ballpark of 2%, there's no reason to have high rates the way we've had, and that the Fed will quickly cut in response. And the thing is, it's not a growth problem, because if you look over at the stock market, stocks are making new highs.
Well, and that seems to be supported, though, also by economic conditions. I mean, set aside the Fed for a second, what they do or they don't do. When you look at the data here and you compare that to the expectations coming into this year here, you have a strong economy. Even with the revisions today in GDP, you're still talking about 4+% growth.
Right, I mean, 4.9% growth is fantastic growth in the economy. And the most recent set of data that we've seen past the quarter has put us at, between 2.5% and 3%, well above potential. And that was before we got this leg up in the stock market and leg down in bonds. And so the economy's in pretty good shape, and typically you only see central banks cut rapidly when you see a meaningful deterioration in economic conditions, and we're not anywhere close to that right now.
People are just operating under the belief that zero interest rates is the norm, and we're going to go back to the norm now that inflation is out of the picture. Is that right?
It certainly looks like it. I mean, for a generation of traders that only traded from 2009, through to today, all they know is a zero rate environment, and what we've seen recently is unusual. But for those of us who go back in trading before the financial crisis and into the 90s, interest rates at 4 or 5% are totally normal and should be expected. And given the healing that we've seen in the economy, a higher neutral rate should be expected these days.
Yeah, well, like you said, it's a generation of traders that hadn't seen that. Mohammed Al-Arian is a Bloomberg contributor, and he wrote an op-ed on the Bloomberg about how the Fed and the markets have this healthy, or I should say unhealthy, codependency. And he calls the central bank's influence deterministic on asset prices and how it was supposed to give way to other factors like fundamentals. But that's being all crowded out by central bank speak, Fed speak, which has been not very effective because it goes one direction and then they have to backpedal and push back. How much of this do you put on the central bank versus on markets and the way they're interpreting the central bank's words?
Well, I think going back to the generation of traders post GFC have been really focused on getting those turns right. The smallest sign of a turn in the economy was a great sign to pile into a particular set of views and then follow that trend. But we haven't seen that really in the last 18 months. In the last 18 months, traders are quickly pricing one direction or another, relative extremes, whether it's higher for longer or deflationary depression after SVB. And the frank reality of the macroeconomy is it's pretty boring, right? The economy chugs along, unemployment rate. We talk about every release that comes out. It's been flat for 18 months. It's been the same number for 18 months, basically. And so I think what we're seeing is a lot of folks trying to call turns, and that's creating relatively extreme market pricing when the reality of the overall economy is we're very, very, very slowly moderating in a way that's, not really anything like these swings that we're seeing in the market.
So everyone's trying to time the market, in other words.
Yeah, I think they're trying. There's a real desire to be the traders that call the turn, and the reality is the alpha today is going to be much more around fading extreme market pricing than it is about trying to catch the incremental turn.
But doesn't that require a lot more bottom-up research rather than just focusing on what comes out of Jay Powell's mouth?
It does. It does. And what it really relies on is you got to start with what's priced into markets, which usually, most people are talking about momentum in the markets rather than what's priced in. So you have to look at that 7 cuts that's priced into the December 24 SOFRs, and you have to say, hey, does that make sense relative to the economic conditions that we're seeing that are pretty strong, and frankly, all this market-based easing that we've seen over the course of the last 6 or 8 weeks? Like, you got to get into that level, start with the pricing, see where it's extreme, and then fade those moves.
We should point out, though, that some of the biggest downturns we've seen in the market, and for that matter, some of the weakness that we've seen in the economy, at least over the last couple of years, have come from sort of these kind of black swan events. Obviously, the pandemic being the biggest one of them all, the war in Ukraine. There's a lot of concern, though, in 2024 that there's still a lot of unresolved issues geopolitically, economically here. And I'm wondering if any of that stuff is on your radar from an investor's perspective.
Well, I think there's nothing that's obvious that's going to come into the market, because otherwise we'd be talking about it already. And so it's much more around, you never want to get over your skis on one particular side of positions or another. And so, for instance, if you're looking at what's going on, you want to position in the markets where growth is sort of underpriced, as well as, extremely underpriced, as well as maybe places where it's extremely overpriced.
Where is that now?
So, for instance, the bond market, we're seeing an underpriced growth scenario. In the equity market, I think we're seeing a real rotation. We're seeing it in the market today, away from those high-flying mega cap stocks who've really taken a lot of the gains and are priced close to perfection into 24, versus those other stocks, the smaller caps, certain sectors that have underperformed. Those are sectors that you could get a real pop in the equity market, assuming the strength continues.
What's the number one thing your clients are asking you?
Well, I think the basic question is: Are we going to see the easing, this incredible easing that's priced into the markets? And I think there's a lot of hesitation about whether that's going to happen. And connected to that is a lot of folks continuing to say that the economy is very weak and the fundamentals are very weak and really worried about recession, but they've been worried about recession for 18 months.
Yeah, they're tired of worrying about recession at this point.
All right, Bob, always wonderful to catch up with you. Bob Elliott, CEO over at Unlimited, helping us count down to the closing bells here. It's a pretty strong rally here as we move closer to those bells here. It was most of the buying coming in the last 30 minutes or so here. Stocks right now at session highs, 1% gains pretty much across the board. Remember yesterday, 95% of the S&P stocks fell. Today, about 95% of them are rising. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast with our friends Tim Stenovic and Jennifer Ryan. Welcome to our audiences across our Bloomberg platforms, television, radio, and our partnership with those folks streaming this on YouTube. Last time we spoke, Tim, it looked like the market was posting some relatively modest gains, but we see a huge uptick in volatility and a huge uptick in prices.
Yeah, I wouldn't call these modest, especially after what we saw a little earlier in the day. We're seeing stocks higher by 1% pretty much across the board, at least right now, except for the Dow, which is up by 0.9%. So perhaps people coming in and buying the dip, or maybe yesterday was a little bit of an aberration with this rally continuing to march higher.
Yeah, and in particular, the Russell 2000 doing better, continuing its streak of outperforming the big, broad indexes since late October. And by the way, the Russell 2000 entering a bull market this week.
It's interesting, too. I mean, we had some of the folks over at Citi, in fact, two different strategist teams, kind of talking about this idea of maybe buying the dip. Basically, the idea we were going to see more pullbacks, maybe not to the extreme as what we saw yesterday, but quite a few pullbacks over the next few weeks here. But the idea that that would just lead to sort of entry opportunities, primarily based on this theory of a broadening out of the rally. So the idea that you can pick and choose other companies beyond that Magnificent Seven.
You know, I was surprised to see, I looked at money market funds today to see how much cash is still in them, Romaine.
Yeah.
It's still close to $6 trillion in money market funds.
It's a lot
there. It hasn't
there.
come off the sidelines yet.
And I wonder, I wonder if it is. I mean, because there's been a lot of talk that it might just move into sort of other cash-like instruments, maybe slightly longer duration, but whether that actually flows back into equities or not remains to be seen. Are you okay? What's going on with your voice here?
I don't know what's going on. I feel fine. I just don't sound good.
Okay.
Not good for 3 hours of radio.
Okay, be careful, Jennifer. Dow Jones Industrial Average going to finish the day higher by about 322 points, up about 0.9%. The S&P 500 posting a 1% gain on the day, or roughly about 48 points, while the NASDAQ Composite higher by 186 points, or about 1.3%. While the Russell 2000, that's your outperformer here on the day, a 1.7% gain. Then that's just coming off, of course, the big losses we saw yesterday. We should point out all of these gains we see today, not quite enough to claw back the losses from yesterday here, but definitely made some meaningful strides towards
It's still pretty broad-based as far as the gains look today. 458 stocks in the S&P 500 is Scarlett moving higher today. Only 42 moved lower. In the Dow, 28 higher, only 2 declined.
Yeah, overwhelmingly to the upside. And that's what you see when you look at the industry groups. So if you split up the S&P 500 into 24 groups, usually there's a smattering of red, there's a smattering of green. But you look at it today, it's green all across the board. You have all 24 groups. You can see climbing and leading the way, autos and components. And then you've got the chip companies. Micron is one of those names. Healthcare and equipment companies up by 1.5%. The laggards are tech, hardware, utilities, and commercial and professional services.
Yeah, if you're just listening to us right now, there's 0 red on Scarlett's screen. So I feel bad for Jennifer because she had to do the decliners today. My job was easy, finding the gainers. I want to start with one that Scarlett mentioned. Micron, among the best performers that I took a look at today, up more than 8.6%. Having their best day, these shares having actually their best day since 2021, climbing to levels last seen since last year. The company, as we mentioned yesterday, after the close, gave a strong revenue forecast when it released its quarterly report. Data center demand is compensating for a slowly recovering market for PCs and for smartphones. Hey, let's take a look at some of the cruise line operators. Carnival Corporation finishing the day higher on the day. Also, Norwegian and Royal Caribbean finished higher as well. Carnival up by 6.2% after the cruise line company reported a narrower than expected adjusted loss per share for the fourth quarter. Analysts who saw these numbers actually said that the profit guidance that the company provided for the first quarter of 2024 was, quote, conservative, still sending shares up by 6.2%. And then ticker KMX, CarMax. Shares were higher earlier in the day by as much as 13%. Paired some of those gains, finishing the day higher right now by about 5.2%. The company reported third quarter earnings that beat the average analyst estimates, strong profit per vehicle, cost cuts, and then investors, Jennifer, they always love a good stock buyback. The company resuming its stock buyback program.
So now let me go into the decliners, such as they are on a day where there's so much green. One of them that I want to talk about is Apple. It's down less than 1%. And, it's had nearly $1 trillion in market value this year. And so investors are asking, well, what's next? Because they've got a lot of headwinds to think about. They've got to arrest 4 consecutive quarters of declining revenue. They've got uncertainty in China to deal with. And then, some government agencies that are cracking down on foreign-made devices. And that was before we started seeing these headlines about the difficulties with the Apple Watch. Because it looks like they've pulled some of those models from the online store, which is not what one wants to really see before the Christmas season.
Hey, I have a question for Tim. Do you use like those blood oxygen kind of measurement things that sort of Apple has gotten caught up in with this patent?
I have yet to buy an Apple Watch, and every year I'm thinking this is going to be the year that I do it. I do like the idea of all the health stuff that they've.
I mean, I asked you because you're clearly the fittest guy on the program right now.
I've never used any of that stuff. I do use a heart rate
for our radio audience. We should
when I go cycling,
just rock hard abs.
All right, back to you.
All right. Jennifer, continue. Just ignore us.
I will do my best. So now the last decliners I want to talk about are Warner Brothers, which is down about 1.5%, and Paramount, which is down about 2.8%. And so these companies have held talks on a possible merger, and this is going to potentially combine some of the biggest media companies in the world. So we're talking about pay TV stations like HBO, famous Hollywood properties like the Paramount lot. But it looks like the market really isn't loving this idea. I spoke to Kevin Neer, he's an analyst at Bloomberg Intelligence, and what he said is actually both of these companies have a lot of debt and also a lot of overlapping businesses. So they're not completely sure that this is the best fit.
And it's also not going to make things cheaper for us, the consumer. They'll be combined, and you'll have everything on one platform, so it'll be a little easier to find things. But it's unlikely that they're going to reduce prices because right now they need to make up for the fact that they don't have enough. They're not bringing enough revenue for all the costs that they have accumulated.
Yeah, it's an interesting question to see what the regulatory reception is going to be for this deal, because they've got some overlapping businesses, but then again, it's kind of like what counts as an overlapping business these days in the era of streaming.
Yeah, good point.
And then, there's going to be some execution risk in terms of when this is going to actually be able to close. So it looks like it might not be an immediate story, and so that will be something that investors will want to watch very carefully.
All right, we should point out we are keeping an eye on earnings here, expecting to get Nike after the bell. But let's check in with what happened in the rate space here. Remember, yesterday we had that 8 basis point drop on the benchmark 10-year yield. Today, those yields went back up by about half that amount, about 4 basis points there. You see the moves across the other part of the curve here. They were all across the curve to the upside here, from the 2-year all the way down to the 30 here, but not quite enough to recoup from what we saw yesterday. We should point out, though, the net effect of it all, at least over this past 4 days here, we really aren't that much further away from where we were about a week ago on last Friday here. So depending on what happens tomorrow, it looks like we could end up somewhat unchanged here in the yield space heading into the final week of the year.
And in terms of what's on tap for tomorrow, there's a lot of data coming out. You've got personal income, personal spending for November. So yes, backwards looking. But the real one that everyone's looking at is the PCE deflator, which is the Fed's favored form of looking at inflation. On top of that, you have new home sales and then consumer confidence, at least soft data from the University of Michigan.
Yeah, so much for a quiet week leading into the holidays. I mean, tomorrow's data dump is pretty massive. And again, we're still waiting Nike earnings right now. It's a good check on the consumer, but also a good check on what's going on in China, because the company certainly relies on China a lot for its revenue.
And then, as we've been saying throughout the whole program, the inflation number is really going to be the key thing, because the Fed's going to be data dependent, and it just depends if we get a nasty surprise tomorrow on inflation, if traders are going to be willing to sort of look through that and count on what the Fed told them at their last meeting, that some rate cuts are coming, or if they get a little bit nervous.
I think it's interesting, though, that when you look at some of the the estimates of economists that we surveyed here, I think it's interesting. Everyone's focused on the inflation side, but I thought it was interesting to see that some of those personal spending numbers are continuing to go up, or at least the expectation is that they will go up, as well as the income levels as well, too. So there is kind of a balance there that even if we do maybe get a potential upside surprise on the inflation front, if we also get an upside surprise on those other two metrics, maybe that'll provide, I guess, enough of a cushion for the Fed to say, okay, everything's still okay.
And also the new home sales, all the housing numbers have started to show a pickup, as well as mortgage rates have come down. And the home builders themselves are offering buybacks on those rates so that people don't actually have to pay, what is it now, the 6.8% for the 30-year fixed rate mortgage?
It's less than 7%.
Less than 7.
Less than it was just a few weeks ago. Happy holidays, everyone. Not going to see you until the
Rest
new
your
year.
voice, Tim.
I
Where
will.
are you going, Tim?
I'm going to rest. Going to California.
Oh, okay,
Yeah.
cool.
Yeah, it'll be fun. I'll be on a plane for a long time tomorrow.
Say hi to Gavin Newsom for me.
I will. He will.
He's quite a guy.
That is going to do it for our Beyond the Bell, our cross-platform coverage right here on Bloomberg Television, radio, YouTube, and Bloomberg Originals. Meantime, catch us tomorrow, same time, same place. Happy holidays. Happy New Year, everyone.
And we continue our coverage right here on Bloomberg Television. Sit tight. We're awaiting Nike results set to cross the wire any moment now. We will bring you full coverage when that happens right here on The Close on Bloomberg. A reversal of yesterday's price action here in U.S. equity markets. A big sell-off yesterday, luring in the dip buyers today here. We clawed back most of the losses from yesterday's sell-off. Not quite all of them here, but enough to give some comfort to some investors, and particularly enough to give some comfort to those investors who are expecting and, more importantly, hoping for a broadening of that rally. We got that today with outperformance once again by the Russell 2000. And in fact, you take a look at the chart behind me and focus in on the white line. Since those October lows that we saw on the major indices, it has been all about the Russell 2000. It has been all about the S&P 400 mid caps, the broadening out of that rally away from the Magnificent Seven to something maybe a little bit more value. SOX, the Philadelphia Semiconductor Index, did get its bid today, led largely by that big move we saw higher in Micron. The KBW Regional Bank Index continues to move ahead as well on the back of a tamp down in those rates. 435 right now is the yield you're looking at here, with the expectation that that can continue to go lower. Of course, the macro is in focus, but so too is the micro. Earnings on tap. We are still awaiting those earnings out of Nike, which are set to cross the wire right now. And Nike, well, it has not been the story to talk about. Only a 4% gain on a year-to-date basis, and it's lagging not only the rest of the market, but quite frankly, lagging a lot of its peers as well. Scarlett?
All right, and of course, we'll break those numbers for you as soon as they cross. But in the meantime, we do want to turn our focus to zero-day options. These are the puts and calls that expire in 24 hours, and some traders blaming them for yesterday's big reversal in the S&P 500. These products have only been getting more popular because now investors in small cap stocks will soon have wider access to these derivatives. Bloomberg's Catherine Doherty has been reporting on the story, and she joins us now. And this is about how zero-day options have worked so well for big caps that they're saying, let's do the same exact thing for small caps. Can you tell us what the change is?
That's right. So with small caps, investors have had access for expirations on Monday, Wednesday, and Friday. As of January 8th in 2024, they're now going to have it Monday through Friday. So SIBO is adding Tuesday and Thursday to the mix. This is similar to what's already happening with S&P 500. With those options, investors have had Monday through Friday since 2022. Now, SIBO, going off of the explosion and the growth and demand that they've seen from their customers, they've said, why not expand that to Russell 2000? And so that's what they are doing. It's not a lot of, I asked about the technological advancement or things that they need to add to basically account for this addition, and they said not much. It's actually very reflective of what's already happening with S&P 500.
What exactly is the demand, though, for the small cap side of this here? I mean, the S&P 500, or at least the large cap side of it, kind of made sense, although I guess there are a lot of people that would quibble as to whether it was really needed. Is there going to be that same type of appetite to do stocks that maybe don't have the same breadth or volume, if you will, as those large cap names.
So SIBA would say the appetite is there and that they wouldn't get into this if they didn't see that same appetite. They brought up that last week with the Fed's decision, they said a lot of movement was actually out of the large cap names into small cap. And so you saw a lot of just investor sentiment being expressed in that way. And if options were expiring Monday through Friday, they might be able to make some of those choices on, let's say, Thursday with Russell 2000, when right now that is not a day that those options expire. Friday is. So they're just saying we want to give more optionality to folks that want to hedge and make some of those bets.
We're just meeting investors where they are.
They are saying that some of these are a hedge. It's a way to, if you're making an investment, a choice in buying a stock, you can then look at the reversal in an option and say that this is protection. And some are just making a bet on what they think the future price of an index or a stock will be. So it really depends. But they've said that they've tried to get answers to what the participants who are using these 0 DTE options are, and that a lot of the times it comes down to protection or, as hedge.
Bets on what could come. So 0 DTE daily trading in small caps. What else is next from the CBOE? Oh, you know what? We actually have Nike results coming out. Catherine Doherty, I think we're going to have to leave it there as we look at Nike earnings. And Nike has just reported the results. Romain, let's look through them. Second quarter EPS of $1.03. Analysts were looking for 85 cents per share. So that is a beat on the bottom line. The revenue of $13.39 billion, a little bit lighter than what had been anticipated. And it was already pretty much flat compared to the same time a year ago.
Yeah, I mean, you take a look at the revenue numbers, $13.39 billion. So they're coming in pretty much relatively in line with estimates. The Street was looking for $13.46. And when you take a look at some of the Greater China revenue here, that did come in a little bit light here, but still a relatively decent improvement on a year-over-year basis. $1.86 billion in revenue out of that Greater China region. Now, the Street was looking for $1.97 billion, but the idea that they've at least been able to maintain some of those levels that they had lost, or recoup some of those levels that they had lost, might actually be somewhat of a salve for the market. Interesting commentary also crossing the wire right now here, Scarlett, too. The company actually saying that they're looking to deliver $2 billion in cumulative cost savings, and they're taking steps to streamline the organization, and that they will provide revised guidance on the conference call. Let's get to Simone Foxman here over at Bloomberg Television, who covers this for us here. This is interesting, Simone. I mean, we came into this expecting to talk a lot more about sales and some of the revenue targets here, but we were speaking with Adrian Yee over at Barclays a little bit earlier, who raised the cost issue and saying that this is a company that has been a lot more focused on that. And at least based on these headlines we're getting right now, it appears they're leaning deeper into that.
Yeah, he's not the only one, though. Citi's Paul Lejuez was talking about how he wouldn't be surprised if they were cutting guidance as well, because he was more optimistic about Nike's ability to protect earnings per share. Again, this margin side. And when you kind of look at these margin numbers that we've got here, the estimate was for about 44%. That was higher than a year-on-year basis, and we are getting something that is at least a little bit touch higher than what analysts were anticipating. But, you know, I think on the China
hang on, hold
side,
that thought, because I'm just curious, too. I mean, when we talk about costs, I mean, I'm just looking at additional headlines crossing the wire, Simone. Again, they did not provide a forecast. They said they're going to give it on the call, but they are saying that they are looking ahead to a softer second half revenue outlook here. And I am curious. I mean, you were kind of looked like you were about to start to talk about China. I'm wondering, is this a China issue, or is this a North American, its primary market issue?
Yeah, to be fair, I'm not quite sure.
Yeah.
I will say, I think that North America has been the strong spot for Nike over certainly the last quarter. That is what sent the shares on a roughly 30% rise after that time. So yeah, Nike was underperforming all year, but in the last couple of months, it hasn't been the case. But now we're looking at least at things that kind of match our estimates here. And if you're talking about weakness in the American consumer, that's 40% of the company's revenue. Yes, China is the exciting place to be, but ultimately, if you're concerned about the American consumer or the North American consumer, that's really what's going to weigh on the company's overall sales. Profitability, I guess, second.
Yeah, it's really interesting, the headlines here. It gives you a sense of the tone and the priorities of Nike, all about controlling what they can control, which is costs, and less about the outlook for sales, which, as Romain pointed out, a softer second half revenue outlook, whether that's in China, whether that's in North America and Europe. Again, something they can't control because it's driven by macroeconomic trends, but costs they can do something about, and laying off workers they can do something about.
And inventory they can do something about.
Yes.
I'm seeing inventory here. Everyone had wanted Nike to really draw down inventory. It had kind of been one of these post-pandemic players that had built up a lot of excess inventory. We're seeing results better than expected. It's $8 billion worth of inventory versus 8.6. I think that is something that's substantial. That is something they can control. Again, to the narrative that you were talking about, Scarlett.
Yeah, we're going to have to dive a little bit deeper into this. We should point out here in the statement, we're talking about a 1% gain in revenue on a year-over-year basis. That was what was expected. But to that question about China and North America here, Nike revenues, the Nike brand revenues, I should say, were up about 1% here, but that was largely because of the growth in China. They saw declines here in North America, and their revenue on Converse also saw a decline in North America here. Simone Foxman helping us break down the earnings. We encourage everyone to stick around here. We're going to dive a lot deeper into Nike earnings, which now seem to be much more focused on cost control. Stick with us. This is Bloomberg. Nike earnings crossed the wire just a few minutes ago. Shares down about 5% here in after hours trading. Overall, revenue was up about 1%, but most of that came out of Asia. Total Asia Pacific and Latin American sales were up 13%. Greater China sales were up 4%. Europe and Middle East sales were up 2%. But here in North America, its biggest market, they were down 4%. John Edwards from Bloomberg's consumer team joining us right now to walk us through these numbers. And two things jump out at me. Footwear in North America, which of course is their biggest business, that was down 5%. Apparel was down 1%. And then their small equipment business, which I think are those awful golf clubs that they make, that actually grew by 10% here.
Yeah.
What's going on? I thought North America was supposed to be the bright spot.
Looks like not anymore. And this is, one of the areas we're seeing people sort of pull back on selectively. It's almost a quarter to quarter thing, and hard to know where the consumer is going exactly. But it looks in this instance like, the appeal of Nike kind of wore off in the quarter to some extent. And, they saw those sales decline, more than people had expected them to. I thought it was, interesting that, the numbers in China were not as exciting as people actually were hoping for as well. So that, that's, a further
Greater
problem
China.
for them there.
Well, footwear was down 1% in China.
Yeah.
Apparel was up 19%. So they're buying T-shirts, but not shoes.
Yeah, I guess so.
But shoes are the bread and butter of Nike, so that's a bigger issue here.
Yeah.
What is the story with Nike and China? If we could take a step back here, I mean, part of it is, yes, Chinese consumers are turning to homegrown brands as opposed to Western brands, but is there something more where Nike didn't really hit on what the Chinese consumer wants, or is this a macro story, really?
Yeah, I mean, it's it's a little hard to parse it, but it's interesting that the company was really bullish on China last quarter. That was a lot of the excitement out of their call from the previous quarter. And it looks like some of that excitement didn't quite pan out. One thing that some analysts were talking about is actually seeing a little bit of a shift back toward Western brands from homegrown Chinese brands. So it looks like maybe Nike is not fully benefiting from that, in the
Well,
way
that's what I'm asking
been
about.
hoped.
And we've seen some of those Chinese. I mean, that was never going to last. I mean, some of them were like pretty hideous.
Nikola Jokic would beg to differ.
Okay, whatever. That's a whole nother show.
Yeah.
But I am curious, though, in all seriousness, about whether this is really a Nike story, meaning people are gravitating from the Nike brand to other brands, or whether this is actually a pullback and just spending on athletic wear overall.
Yeah, I mean, athletic wear, I think, had been a category that had been holding up fairly well. I think, Dick's Sporting Goods and some others had seen.
But in terms of the brands, because we talk. I think we were talking a couple weeks ago about Hoka. Like when some analyst went to Central Park and he ended up was counting the numbers for shoes and said that I forgot what determination he came to. Something like Adidas was losing.
Yeah.
But the idea was that there are so many more brands now to choose from, whether you're a serious runner or whether you're just doing it for fashion. You have a lot more options than just Nike.
Running is doing well, so there are definitely more options, and it's a tougher marketplace for them. I think in some ways that might be why they're turning their focus to, as we were talking about before, what they can control on the cost side of things, and that could be part of this cost cutting effort that they've announced today.
How much does this align with what we've heard from Lululemon or Under Armour, the kind of narrative that is coming up with Nike, where the top line is pretty bumpy, so right now they're going to focus on margin expansion, and that's what they're laser focused on until growth comes back on the top line?
Yeah, I mean, certainly Under Armour continues to be in sort of a turnaround effort, and so they're very focused on getting their operational house in order. And Lululemon, was, sort of surprisingly downbeat in their last report. And so, again, I think we're seeing some of these companies try to look at, again, what they can control internally and sort of try to at least get on a good internal footing so that they can take advantage when the market does come back.
I thought it was interesting. Their inventory levels were down pretty significantly, in line with what the street was looking for, down 14% on a year-over-year basis. That's a good thing, right?
Yeah, that's a positive trend that continues from the previous quarter. They were down 10%, so that's accelerating.
Because we were talking earlier about just anecdotally the idea that we were starting to see a lot more discounts out of Nike.
There's some Air Jordans on sale on the website.
So this is what Scarlett's been looking at. I think she's bought like 12 things.
Well, there you go. But I think, part of what people are looking for with the inventory declines is that they want to see them, clear out some of the older, less popular items and, be able to sell more of the higher price stuff.
So did you get the Panda Dunks or you got
I'm still working on it. During the commercial break, I'll buy a couple more pairs. John Edwards, thank you so much of Bloomberg News. Coming up, we have more on Nike. This is The Close on Bloomberg.
If you had any doubts about why the sell-off yesterday was much more technical than fundamental here, you got the answer today. A big updraft here in most equity markets. We did not quite claw back all of the losses from yesterday here, but you did see a lot of progress, a 1% gain on the S&P 500, and that was really the narrative for most of the other major indices. A broadening out of the rally once again here with the Russell 2000, the cyclicals, the small caps, really taking part, not only taking part, but quite frankly, taking center stage. The yield picture here was a little bit more stable than what we saw yesterday here. We should point out volume is down, as you would expect, just a couple of days out before the Christmas holiday here in the U.S., and of course, with just 1 week left here in the year, this might be the best price action that you're going to see, at least until January. Scarlett?
All right, and of course, right now it is Thursday, and companies are reporting earnings. The latest, of course, is Nike. It is a big mover here in the after-hours trade, moving to the downside. As it reports, it's making some changes, identifying opportunities for up to $2 billion in cost savings, streamlining its organization, and therefore seeing pre-tax charges of up to $450 million. I want to bring in now CFRA equity analyst Zach Waring to give us more. Zach, when you hear from a company like Nike that it is streamlining its organization and it is taking a pre-tax charge, it's going to revise its guidance, but these are all vague comments so far until it gives details on the call. What's running through your head?
Yeah, I think Nike's a company, they're seeing, a little bit lower growth than they've, had in the past. They've, have been able to grow revenues, 10+% in past. And now they're looking for other ways to please investors. And one of those is to, get expenses under control and, grow the bottom line in other ways than just top line growth. So, I like the initiative. I think over time it should, benefit the stock, but obviously you've got to hear more about it in the call.
We got to hear more about it. $2 billion in cost savings. Is that a lot? Is that little, given that everyone knew the short term would be kind of bumpy, but they were looking ahead to top line eventually picking up sometime in the second half, and that's not the message we're getting from Nike.
Yeah, it's $2 billion over 3 years. It will make a difference. It's going to be interesting though. Now, you've got the incident in the Red Sea. So they've been benefiting this whole year from lower freight costs, ocean freight costs, which now is probably going to reverse, at least in the near term. So it's going to be interesting to see what they have to say about, where they're going to see those costs, savings.
Were you surprised by the announcement here of this cost program, Streamlined Programs Act? Because the last couple of conference calls, and more importantly, the last couple of releases, we did not really hear a lot of talk about this.
Yeah, it's not something that you typically hear from Nike. Nike's pretty much straightforward, quick earnings call, and they don't usually have these restructuring moves. So it was a little interesting, and definitely something to listen for in the call.
Yeah.
I do think that the quarter itself was a pretty good quarter. Obviously not as high growth in China as you'd like, but overall, gross margin, significant improvement there. I think 170 basis points, which is big. Obviously, they've benefited from a little bit higher prices and better freight costs, like I stated earlier. So it's going to be interesting because I think their outlook is probably going to be revised, I would assume, down on the EPS number as well, just because I think the issue in the Red Sea is going to throw some red flags.
Well, that's what I'm curious
management.
about, because when you talk about the costs in the most recent fiscal quarter here, they specifically cite the drop in container costs and other things like that here. Costs that we know, at least based on aggregate data, have gone up pretty significantly over the past couple of months here. I'm looking at a company here that has managed to get its inventory situation in check, a company that still is sitting on, I don't know, like $8 billion in just cash and cash equivalents alone, and that doesn't even count the short-term stuff here. So this is still a pretty healthy company financially when you look at the balance sheet here. How does John Donohue sort of get to a stage where he can look at an uncertain picture when it comes to the cost picture here and make decisions for the long term that are actually going to benefit Nike?
Yeah, it's like you said, they've got an incredible balance sheet. They've got almost $10 billion in cash and equivalents. They're doing this quarter, I think they did over $1 billion in share repurchases. So, there's nothing to, get scared about here. I mean, the company's got one of the best balance sheets in the world in terms of retail. So, yeah, I mean, I think this is probably just to, maybe offset some of the slower revenue growth that they're going to see over the next 10 years, just because it's a mature company. And I think that's the right move by management.
Right, but it's not a growth story anymore. And I think about how much the stock rallied since the last earnings report, up 37%. This idea that, yes, there'll be lower freight costs and margin expansion, but also that, looking far ahead, there are brighter skies, that things were going to pick up. That has pretty much been dampened by the company saying it sees a softer second half. Talk to us a little bit here about whether the financials, things like this $2 billion cost savings program, the increased dividend that they announced last month, is enough to keep investors there waiting and patient for that turnaround when it comes.
Yeah, I think you're seeing a little bit of it in the after hours here. I think investors need a little bit more growth in their showing, and their multiple is a little bit high. Pre-pandemic, their multiple, traded between 20 and 35 times, and it's getting towards the high end of that now, at like 32 times next year's earnings, which we aren't sure are going to be, what analysts think. And so I think it's probably not good enough, and I think you might see the stock trade down from here a little bit, but it's a great company, a great brand. Obviously, they've got an incredible balance sheet, and they've got a really good capital return program, so that offsets some of that slower growth.
What's the one thing that John Donahoe could say on the call today that would turn this decline around and have it rally tomorrow?
I think if he gets better than expected guidance in terms of EPS, obviously they've mentioned that they're going to, I think lower their total sales target for the year. So if he comes back and says, but we're going to raise our EPS guidance, or even, keep EPS where it's at, I don't think investors are going to, care too much about the slowing revenue cost. It is bad that, China's been subpar this year. People thought China would maybe grow 25% or better. And that's just not been the case. But and then U.S. is stable, but there's, they're mature in the U.S. So it's going to be tough to, grow in the U.S. from now on without significant price, improvements.
All right, Zach, great to catch up with you. Always appreciate jumping on here on a busy day for earnings. Zach Warren over at CFRA, a closer look at Nike shares. Softness on the revenue side, but more importantly, a relatively stunning announcement here about a cost reduction strategy. That conference call set to start in just a little bit more than 20 minutes. Meanwhile, we want to go from, I guess, one of the big laggards in the apparel space and talk about, well, some of the big outperformers on the year. That includes home builder stocks, on pace right now for their biggest annual advance in over a decade. A remarkable rally considering, well, just how high mortgage rates got in 2023. Now that those yields are coming down from that lofty 7% to the halcyon days of 6%, what can we expect for the year ahead? Nora Melinda joining us right now. She has been covering this story for us here at Bloomberg News. And look, even with the big jump that we saw in mortgage rates, the resiliency of a lot of these home builders was really on display. Was this a function less of mortgage rates and more just of supply demand?
I mean, this was a story that many people didn't expect to happen. I mean, you've got decades high interest rates and limited existing home sale inventory, but with insatiable demand for houses and a nationwide shortage, it really provides amazing leeway for home builders, which we are seeing the sector on pace for its best year since 2012 and highest level on record.
So the big issue, of course, is mortgage rates and how prohibitively expensive they were. Now that rates are coming down, and should the Fed cut rates, the mortgage rate will go from what currently is 6.8 on a 30-year fix to something lower. What does that mean for the home builders in particular? Because as you and I were discussing earlier, a lot of them were incentivizing buyers by buying down the mortgage rate so that they wouldn't be paying the 7 or 8% rate.
Right. So we were seeing a lot of rate buy downs. We saw a lot of home builders capitalizing on that to ultimately entice buyers to come buy their homes. But moving forward, the conversation has really been around if rates come down and you start seeing people wanting to move out of their homes, what will that mean for home builders? But ultimately, I've been speaking to analysts who say that it could still potentially end up being a positive for the sector.
Because it'd be competition.
Of course. Yes, the notion is that there could be competition, but the competition may not actually be that much given the fact that those who are moving out of their existing homes could be looking to home builders to move into a new space.
Is there an idea that we could see actually some change in pricing in terms of the pricing of the homes? Because there was a lot of talk as to why we didn't maybe see a little bit more discounting rather than the incentive route that Scarlett was referring to.
So there's been a lot of incentives for home builders historically, and that incentive shift has changed from maybe giving somebody a free dishwasher or something to that effect to now
a dishwasher.
Yes, I mean before there were always
like an actual person to wash the dishes, or
if only, only. But no, an actual dishwasher, maybe some free countertops, some different elements at play. But that has ultimately shifted to rate buy downs. So we are still seeing some strength when it comes to pricing. Ultimately, some analysts are saying maybe consumers are just getting comfortable with the mortgage rates.
Yeah,
this is a missed opportunity, Scarlett, because if they said we're going to promise you a dishwasher, and maybe, I don't know, maybe a cook or a chef or something for like years to come. That'd be
Don't you know services wages are much higher
that'd be a big
than
value
product
proposition
costs?
for me. Yeah, I don't know what that would do to the Fed and inflation. But
all right, Nora Melinda,
I'd be a buyer.
thank you so much. Yeah, okay.
I'm just saying, Nora, can you talk to them?
I'll try.
The home builders need to listen to this suggestion. All right, Nora, thank you so much. Coming up, we've got a check on the consumer outlook from Wendy Liebman. She's CEO and chief shopper at WSL Strategic Retail, giving us her take on what's going on in the retail sector. This is Bloomberg. We have a slew of U.S. economic data coming out tomorrow, including a key inflation metric, personal income, personal spending numbers, along with durable goods orders. So let's discuss all of this with Bloomberg's Matthew Bosler. And Matt, I go to EcoGo on the Bloomberg, and the entire screen is filled up with data points that's coming out tomorrow. But the key one here is PCE core deflator. This is the Fed's favored inflation metric. Why? What does it show that the other inflation metrics don't show?
Well, it's really meant to kind of capture more broad inflationary pressures in the economy than just the CPI, which is a little bit more focused on what consumers are paying out of pocket for things. And so the PCE incorporates prices of goods. For example, healthcare is a big difference where you have insurers paying a lot of the costs of healthcare to the providers. And so it's just meant to be a somewhat broader gauge. And that's one of the reasons why the Fed likes to focus on that instead.
Is the trend line, though, as we've been told time and time again, still to the downside?
Yeah, in fact, I mean, inflation is really kind of in free fall right now. I mean, that's been the big surprise over the last few months. And even last week with the inflation data we got, I mean, it's just been kind of stunning how quickly inflation has come down, contrary to expectations, right? A lot of people were saying, oh, we're entering that kind of last mile for inflation. The last mile is going to be the hardest. It's looking more like the last mile might be the easiest, the way these inflation prints have been going.
So this is a big print for the Fed to focus on. What else will it need to look at in order to determine exactly when it's going to start cutting rates?
Well, so I think, we do need to see the next couple months of inflation prints ratify the expectations that are currently in place given the last few prints. I think a lot of people are seeing a continued downtrend for inflation. There are some question marks, some moving parts the next few months in the reports that will determine whether or not that continues to be the case. But then also, of course, the labor market data are going to be very important, right? We've had several months of labor market data now where it looks like they're starting to get choppier. We've seen, scarier prints to the downside, but then bounces back up. The breadth of job growth has been decreasing, and it's really relying on just a handful of sectors versus earlier in the year. So those are all things that are going to be important.
The one thing I'm interested in here, Matt, I mean, we focus obviously so much on the deflator number, because we know that's what the Fed, we're also going to get the spending numbers, the personal income numbers and the personal spending numbers. And that trend line actually looks pretty good, even when you adjust for inflation. That's holding up pretty well. And I'm wondering, is there a sense here that even if we do, for some strange reason, get an upside surprise in inflation, that there is at least some sort of balance when it comes to the health of the consumer?
Yeah, absolutely. I mean, that's been one of the big surprises all year, as you know. And, the last quarterly GDP print we got that was, about 5%, that was something that surprised a lot of people. And after that, there was a sense that, okay, the fourth quarter GDP number is going to be a lot weaker, right? Because there was some demand that was pulled forward into the third quarter with all of the Taylor Swift mania and all sorts of summer-related spending. But the data that we've gotten since then that are tracking for the fourth quarter are actually looking really strong as well, such that you're going to get a GDP print for the fourth quarter maybe above 2% as well. So then you start to average that with a 5% number, and you've got a really strong kind of growth picture for the second half of 2023 that just has continually surprised to the upside.
Yeah, I really hope there's a big music tour next year. Otherwise, we're all in trouble. Matt Boesler covers the economy for us here at Bloomberg. A preview here of what to expect out of that PCE data, 8:30 a.m. tomorrow out of Washington. Meanwhile, we continue the conversation about the health of the consumer with who better than talking to us about. Wendy Liebman joining us. She's the CEO and the chief shopper over at WSL Strategic Retail. Great to have you here on the program. And let's talk to me about the health of the consumer, because I hear so many kind of conflicting reports. There's hard data that seems to suggest we're still spending. There's a lot of anecdotal data that seems to suggest that people really are struggling and maybe actually now starting to pull back. What are you finding?
Yeah, the latter, I must say. We haven't stopped spending. But what we hear from lots of consumers around the country, in the thousands, is that they are feeling very nervous about what the new year will bring. And I think when you get to, in spite of the fact that inflation is declining and making people happy, when it comes to everyday things that they're buying, still food or rent or technology, any of those kinds of things, and student debt, which is loaded up on a lot of people, they are feeling concerned.
Are they shopping less, meaning are they buying fewer things, or are they simply, I guess, buying the same amount of things but looking for, I guess, bargains and discounts in order to defray the cost?
Yeah, both. They're buying, they're very cautious about the price they pay for anything, which is why you see those retailers who are offering better prices, the ones who are doing best. They're also buying less of things. They're just cutting back. It's this sort of philosophy of just in case. I better be careful, just in case. So we see that over the holidays. We think we'll see that through the new year. There's this just sentiment of ill ease or unease. So I hate to be a naysayer, but it's a worry.
How are the retailers positioned for this? We just heard from Nike where the inventories are looking better, but they're going to embark on this $2 billion cost savings program because they are trying to control what they can control, which is their expenses, because they have to wait for the larger, broader global economy to recover before they have a real growth story to sell to investors.
Yeah, and that's one of the things you're seeing either on the retail front or on the manufacturer front supplying the retailers. They're very concerned about inventory. there's been a lot of price increases. And when you're in like the consumer goods business or selling consumer goods, everyday essentials, there's that, how high can the prices go? Well, 3/4 of the people we talk to around the country say that they believe prices will continue to go up, even though inflation is going down. So it's a sentiment thing as well as it is the reality, which is making it hard. So a lot of the retailers are either thinking about how many things they carry, how much inventory they carry, their price points. There's a lot of conversation going around about, I'm going to simplify my offer. I'll have fewer products,
They also need to be more creative in packaging what they are selling as well, because, I don't go buy chocolates every day, but when I do, I notice that the boxes are a lot smaller. The packaging is a lot, shoddier than it used to be. So it's up to the retailers to offer up a different experience.
Yeah, I think that's really the other issue, this sort of the frustration. I don't know, chocolates is yours, tissues are mine.
Tissues,
the little tissue box now, it's got 65 instead of, I think, was 80. And you're like, is the price the same, but I'm getting less? And it's really frustrating. They're really good at figuring, the cereal boxes, those kind of things, with less in it. But to your point, it's also about, is there anything interesting to buy? That's the other piece.
Yes.
And I can tell you a funny story.
Yes,
we buy the same cereal. I won't say what brand it was.
Okay.
And we bought it again. The box was bigger, but then we looked at the fine print, and it was actually fewer ounces in it. Right. Even though they raised it.
It was an empty box.
Anyway,
empty box.
Yeah, anyway, that's an aside here.
No, but that's you being a consumer, right? And
yeah,
it's
it's consumer.
Really
and people are starting to notice this stuff.
Right.
I am curious, just on the idea of the holiday season, which is supposed to be a time where we do kind of spend freely, hopefully for other people and not just ourselves here. Right. Are people buying, the more, non-essential stuff, jewelry and things like that? Or are we all going to just get like socks and like T-shirts?
And gift cards.
And gift cards.
Gift cards, yeah, and chocolates.
Yeah.
Chocolates are good. Those sort of things. There's a lot about essentials, people who just stuff they need. The really big thing that, we're seeing is beyond chocolates, the proverbial experiences, buying tickets for theatre, tickets for the shows, gift cards for things like that, travel that, is quite expensive these days for people. So it's as opposed to just more stuff. And then the one area that I think we will see the difference is people are not doing that, and one for me. Because that was an area where you started to see retail sales really pick up. So it's sort of quite nuanced.
There's no treat yourself anymore.
No, not this holiday season. Just do what you have to, and then I'll wait till next year.
All right. Well, we need to catch up later in 2024 because I am curious to see whether this is kind of the start of a new trend, and we do end up seeing a little bit more weakness in the consumer space. Wendy Liebman, who's been covering this space for decades, really, CEO and chief shopper at WSL Strategic Retail. All right, stick with us. After the break, we're going to set you up for what to watch tomorrow. This is Bloomberg. All right, still a lot of potential market catalysts out there. Let's look at what markets will focus on over the next 24 hours. And we're actually going to start off in Japan.
Yeah, we get the minutes from the last BOJ meeting, not the one in December, but the one in October, as Sherry Ahn just informed me. So it's really backwards looking, but we also get CPI numbers, which will be more relevant to what the BOJ does next.
Yeah, and remember, the CPI story, the inflation story there has actually been somewhat encouraging here for a country, of course, that's been dealing with deflation for so many years. Meanwhile, over in the UK, we're going to get some economic GDP data.
Yeah, and that comes out at 2 a.m. And I think after that comes out, everyone's going to be looking ahead to the U.S. releases.
Yeah, you'll be up at 2 a.m. for the GDP data in the UK. I'm going to wake up at 8:30 a.m.
Okay.
U.S. personal income, spending, as well as durable goods tomorrow.
Yeah, it's the line of items that's coming out tomorrow. I was counting 19 separate line items under EcoGo on the Bloomberg terminal.
Yeah, this is kind of the last hurrah for the year in terms of economic data, but a very critical economic data as well. In addition to the inflation data, the personal spending data, durable goods, and whatever other 19 items you're looking at, we're also going to get some insights into home sales and consumer confidence.
Yeah, especially with home builders flying high. The question is, how much will lower interest rates really encourage these builders?
All right, we really appreciate you tuning in today. We'll be back tomorrow for all your markets coverage. But stick around. Balance of Power coming up next, right here on Bloomberg.